Hi everyone, I believe I'm live. Let's make sure that there's no comments or issues. Great, I think we're good. Okay guys, I wanted to do a live stream. I got a comment from Jack, which asked what my view on a recession is, and it's not as easy. It's not as easy to say yes, I think there's going to be a recession and assume that everything is going to play out fairly rudimentary like what we've seen in the past. There's a lot of recency bias. A lot of people are saying that the consumer's tapped out, we're in a recession. And that's not really a fair reflection of where we currently are. What normally happens in these moments is we know something's wrong. So automatically what we do is go back and look at the last crisis and assume it's the same. So because it's a lot more difficult today, I wanted to show all of the data, the challenges that we see in the market, the divergences between specific sectors, to better understand the current market environment. Because sometimes you go into a recession and not every recession looks exactly the same. If you go back to March 2000, if you were smart enough to sell the absolute top and then ultimately cover right at the bottom, sure, you made 40% and you might have done very well. But counterintuitively, if you had bought an apparel company or a home builder, precisely when we went into that recession, you would have made 150, 200% of your money over that same period going long, highly discretionary, highly cyclical sectors. And so today has an awful lot of whiff of those type of recessions because the consumer is actually in great shape and spending very much in a discretionary manner. And I'll show you guys that in just a moment. You've seen it today from the report from Crocs, delivering on a constant currency basis, 63% growth year on year, 57% factoring in the US dollar headwinds. Remember, a lot of their business is international. So even with all those challenges, these discretionary businesses are doing incredibly well. Etsy up 15% on the day. They sell gifts. How much more discretionary is that? It's more gifts, very robust revenue, which is not really what you'd see heading into a recession. So it's a very interesting question that Jack asked, and I wanted to share just how difficult 2022 actually is, and hopefully share with you how the portfolio is positioned, why. And for me, it's just it's more about time as opposed to trying to time different peaks and troughs. Hey, Tom. Hey, Sam. Okay, I'm going to share my screen. I'm just going to pop it up. We're going to start off with breaking down what GDP is. A lot of people look at sort of like a recession as 2 negative quarters of GDP. It's usually aggregate demand rolling over, and GDP is not really a good metric to use. And I'll tell you why. GDP is personal consumption expenditure, government expenditure, plus gross domestic investment, plus exports minus imports. And the first three parts of that equation for GDP make a lot of sense for domestic aggregate demand, essentially. But the last part of that, which is imports and exports, is not really a good measure in the United States. And the reason being is, if you have a look at imports solely, it's only about 15 to 17% of GDP. The United States is sort of relatively domestic demand led. And when you look at the difference between imports and exports, it's only about 4% of demand, or 4% of GDP. But over the past 2 years, after COVID, we've seen a massive boom in imports. And now with what's going on in Europe and the export of LNG over to Europe, you're seeing a massive boom in exports. And so it's completely skewing the numbers, both on the downside and the upside. But we can focus on that first part of the equation, which is personal consumption expenditure, it's government expenditure, and it's gross domestic investment. What I have here is that personal consumption expenditure year over year, plus government total expenditures, plus gross domestic investment. And as you can see, year on year, that's up 16.28%. Now, if you wanted, you could exclude out 8% for that just to show that inflation adjusted over the past 12 months. This is still real growth. It's still growing at a pretty decent clip. However, when you look at personal consumption expenditure, that's essentially the consumer, that's $17 trillion. When you look at government expenditure trailing 12 months, it was $8.8 trillion. So what that means is the consumer is about 70% of the US economy. The US government's about 30% of the US economy. The reason why that's important is when we look at the two of these, when we look at government expenditure, throughout COVID, what happened? We went to 0% in interest rates. The Federal Reserve started monetizing US government debt, and we had $7 trillion in fiscal spending. What did that mean? This blue line here is government expenditure year on year. we had a 47% growth during COVID for government expenditure. Fiscal stimulus went through the roof. And at the same time, because the economy rolled off a cliff, we essentially shut everything down. We've seen personal consumption expenditure roll off a cliff as well. Consumers couldn't spend money even if they wanted to. What we're seeing as of right now is personal consumption expenditure is carrying the economy. And what we're seeing is what's known as fiscal drag. It's the US government year on year, government expenditures down versus a year ago, about 3.8%. So you're seeing a slowdown in government spending, but you're still seeing robust spending in terms of personal consumption expenditure. That's the current condition. That's what we've seen all year. Many people that have been calling for a recession, it hasn't materialized because consumers in a lot better shape. We're going to look at more of that data a little bit later. Last quarter for Q3, GDP now estimated 3.1%. This is real GDP. So this would be inflation, whatever the inflation number is. Let's say it's 7.5%, 8% plus growth on top of that. Nominal would be, let's say 7.5 plus 3, you'd have 10.5%. That would be nominal growth. Real GDP essentially excludes out that inflation, and you get 3.6%. So this is showing that the economy in real terms is growing. Last quarter is 3.1%. This is still way too early to use. It's only 3 days into Q4, but it's starting pretty damn strong, starting off at about 3.6%. That's based on the data that we've had for the first 3 days, which includes ISM manufacturing, PMIs, and it also includes ISM service sector. It's showing 3.6% growth. So as of right now, GDP, if you want to use that metric, I prefer to exclude imports, exports for the reasons I mentioned a moment ago. Last 2 years, it's been very cloudy, not really a fair reflection of what we're seeing. But when we're looking at personal consumption expenditure, government expenditure, and real gross domestic investment, those three are still growing at a healthy 16.2% year on year. So that's essentially where we are as of right now. We haven't rolled into a recession. That's not to say that we can't in the future, but the question is, where does that recessionary fears come from? Is it going to come from the private sector, the consumer, 70% of the economy, or is it going to come from the government? And this is the part where recency bias steps in. Everyone says we're in a recession. It's very negative out there. Households are tapped out because of inflation, when in fact, aggregate data is not suggesting that whatsoever. So let's have a look here really quickly at the US government, and then we'll have a look at the consumer, and I'll show you the difference between the US government and the consumer. If we were to go into a recession, it's highly probable that it's due to austerity driven by the US government, scaling back that expenditure. As they scale back that expenditure, it's less dollars going into the economy, and so it shrinks. Household balance sheets are still very strong. They may scale back some of that spending. We'll have to wait and see. If unemployment increases, they'll scale back some of that spending. If unemployment remains robust because the participation rates dropped 4 points over the past 10 years, 12 million people are absent of the labor market because we're seeing an aging population start to retire. Well, if the labor market doesn't start to see unemployment increase, you're going to continue to see personal consumption expenditure grow. So let's start off here. This is federal debt as a percentage of GDP. Gross domestic products, $25 trillion. Debt is $30.5 trillion. We have more debt than an annual GDP rate. If we pop on over here real quickly and we break it down, we've got federal government expenditure in terms of interest payments overlaid with government debt. This is where the challenge is. In red, we have public debt. It's at $30.568 trillion. Now, if you take the interest payment where we are today, it's at $736 billion per year, and you divide it by total debt, $30.5 trillion, we're at about a 2.4% interest on the current debt. And the reason why it's important to note where we currently are on that debt is because if we have a look at where government bonds are for 2 years into the future, it's at 4.7%. And 4.7% on government debt is well in excess of $1 trillion. This is where the challenge happens and why you're seeing that fiscal drag. If we have a look at the US government's balance sheet, now this is from the Bureau of Financial Services, it's a US government website. They give you the projections in terms of tax receipts and spending over the next 75 years. The reason why this is over 75 years is because we've got a fair idea of how long somebody's going to last, how many years they're going to spend in the labor market, the average inflation rate plus the average salary growth, and the average tax rate that the government's going to receive. We've got a fair idea of that over the next 75 years. So you can budget for that. And the first thing that you notice here, if I zoom in here, is total receipts over the next 75 years is $332 billion, but non-interest spending is $430 billion. We've got almost $100 trillion in deficit, or fiscal gap, essentially is what we have over the next 75 years. That's $1.3 trillion in deficits every single year. What that means is the US government needs to spend, according to their budget, 1.3 trillion more than what they currently bring in. And that is not interest expense. The interest expense as of right now is at 736 billion. But if we get to 4.6%, where the 2-year bond yield is, if we refinance the whole curve, the US government will be paying about another 1.3 to 1.5 trillion in interest. So they need a deficit of $3 trillion. Essentially what that means is the US government's bankrupt. The US government's already bankrupt. And as interest rates increase, it puts a lot of pressure on the US government to cut back expenditure. A lot of this is social welfare, it's pensions, Medicare, Medicaid. If you cut that back, ultimately what you're likely to see is the social fabric of the United States break down even further than where it currently is. Outside of that, you could cut back defense. And all we're seeing as of right now is defense expenditure increase. So as of right now, where could you see some sort of fiscal austerity to cover that gap? It doesn't look like there's a huge amount of room. And so it increases the risk of default at some point over the next couple of years for the US government, unless they cut back their spending or the US government or the Federal Reserve cut interest rates. That's where we are as of right now. But the US government's already bankrupt. They're technically bankrupt, and they're relying on artificially low interest rates and a buyer of last resort, which is the Federal Reserve. And as of right now, the Federal Reserve are raising interest rates. As you guys know, what that's doing is it's driving higher interest rates in the US, but it's driving the US dollar higher against some of their global allies. So look at the Japanese yen, it's down about 30% year to date against the US dollar. You look at the British pound, it's down about 15%, euro by 15%. Every major developed market is struggling as of right now because of the dollar strength. And that's all driven by monetary policy. So you've got an issue as of right now where we have a very strong dollar, which on a constant currency basis, we're still seeing growth because the consumer is fairly strong. But when you adjust it for US dollars, you're seeing an awful lot of companies, for argument's sake, Meta recently posted a 2% growth year on year in revenue on a constant currency basis, but negative 4% when you adjusted it for US dollars. Same situation with Amazon. Amazon had an impact of 4.6%. They were anticipating 3.9%, but it impacted their business. So a strong US dollar is crushing international markets, and the US government are having to scale back some of their expenditure because they don't have enough money to balance their budget. So what's happening is, as I mentioned a moment ago, we're looking at the last battle. It's what's known as recency bias. Go back to global financial crisis, household was over-levered, and then ultimately we went into a massive credit crisis. You had a global financial crisis. That was driven by households. Today, it's the inverse. Today, the consumer is in great shape, but the government is in absolutely horrendous shape. And a lot of the shrinking that you're seeing in terms of expenditure is actually coming from the government sector. So 20,000 jobs on the recent NFP was from the government sector. So the government's starting to get smaller, scale back some costs here and there because they just don't have enough cash if the Federal Reserve continue to increase. Now, many people are looking at the market and saying, we haven't seen any destruction yet. We haven't seen capitulation. We haven't seen anything like that. And I'd argue that we're looking at the wrong metric. We should be looking at the volatility of US credit. Treasuries in the US, if you look at TLT as an example, it's down 38% year to date, and it's down over 50% off its peak. This is supposed to be somewhat risk-free. It's supposed to be backed by the US government, and it's trading like a penny stock. So what ultimately we're seeing right now is total illiquidity in US government treasury market because the US government's bankrupt and nobody is financing their debt. Over in Japan, they've got $1.2 trillion in US treasuries, but as of right now, they have to sell those to defend their own currency. So far, they've sold $90 billion. So they're a seller of US treasuries. The Federal Reserve want to do quantitative tightening. They want to sell US treasuries. They don't want to own them. SLR requirements essentially means that the commercial banks can't hold any more treasuries because they need to keep a specific amount of cash reserves on the balance sheet. And so nobody wants to own US Treasuries either through regulatory requirements or through necessity to sell off their balance sheet. The only natural buyer of US Treasuries right now is the Federal Reserve, and they seem to have their head buried in the sand. As of right now, if we look at the volatility in US Treasuries, which is usually driven by illiquidity, it's the MOVE index. Bond market volatility it's already ahead of where we were during COVID, and we're on our way up towards global financial crisis highs. The Treasury market has probably, you could argue that it's already capitulated. As you can see, it just absolutely got smashed. There is a certain amount of time before the US government will really need financing. I think it's a lot sooner than it isn't, because there's $600 billion in TGA. There's $4.5 trillion in tax receipts. That's a total of $5.1 trillion. They need, well, over the past 12 months, they spent $8.8 trillion. Let's assume that they only do $6.5 trillion, which is the average based on their budgets. They still don't have enough, and they have $730 billion in interest payments. So the US government is very much short on cash. They don't have enough income to service their debt, and they're effectively bankrupt. The crisis that we're seeing at the moment is entirely driven by US government. It's essentially possibly insolvency. I don't think it gets to there, but that's essentially where we're heading. That's why you're seeing this type of volatility. So let's have a look at the consumer really quickly. Why do I say the consumer is in great shape? I'd like to believe that I'm somewhat objective and I'd follow the data, but if we have a look here, this is the Federal Reserve's data. If you have a commercial bank in the United States, you have to report the amount of liabilities and assets on your balance sheet. Part of your balance sheet's assets are deposits. Part of them are liabilities. If we have a look here, we have consumer credit and mortgages. Both of those make up about 16.7 trillion. And if we have a look over here at deposits make up 18.5 trillion. If you take the deposits away from the consumer credit and mortgage credit, we have a situation where we have net savings of 1.8 trillion sitting in a household's balance sheet. If you go back to 2008, if you want to go back to even 2007, you had $8.12 trillion in deposits. And if we have a look at where we were in terms of Q4, in terms of mortgages, we had about $13 trillion in liabilities. So it was a shortfall of 5-6 trillion negative. Now we have a positive. Today in 2008, it's day and night. We're not in the, it's not even close to being the same. And that's why companies like Crocs are still putting up, deep into the year in 2022, they're still putting up 57% growth despite the strong dollar, 63% growth in constant currency basis. That's year on year to sell a discretionary shoe. That's not something that is perishable. You could buy a shoe, I have Crocs from like years ago that still work perfectly fine, yet they still continue to do 57 to 60% growth year on year. Absolutely fascinating stuff. And so consumer brands, depending on how well they're run, because as of right now with high inflation, if you can't pass those costs on, your margins compress, you're getting crushed in the market. If you can pass on those costs and perform very well, take Crocs as an example, it's up 65% since the June lows. It's just far too cheap. I'm using that as an example because they reported today and I know what their numbers are off the top of my head. But today, the consumer, it's day and night versus where it was back during the global financial crisis. It's not even close. If we have a look at the latest delinquencies, a lot of people say delinquency rates are increasing. I don't know where they're getting the information from. Mortgage Bankers Association report this every quarter. Q3, which came out 2 weeks ago on the 17th of October, here's what they had to say. A much smaller share of loans backed by the property types hardest hit at the onset of the pandemic, lodging and retail, were delinquent. For those property types, very few new loans faced difficulties and lenders continued to work through those that they had. Additionally, loans backed by the property types had been performing well throughout the pandemic. So we have mortgage rates in excess of 7%, yet we're seeing delinquency rates go down. And what a lot of people miss is wage growth is roughly 6.4%, I think, year on year, coming off of highs of 6.7%. You have wage growth of over 6%, and you've got an average fixed rate mortgage of 3.3% on a 30-year stack. 98% of all mortgages on the 65% of homeowners in the United States is fixed rate mortgages. So the vast majority of US consumers their home has gone from a liability to an asset because their wages are growing at a faster pace than their interest year in, year out. And so they're starting to print cash flow. Unfortunately, renters are going to get squeezed and anyone that decided to have a variable rate mortgage, they're going to get squeezed. But 98% of the 65% of home ownership in the US has a fixed rate mortgage, and that fixed rate mortgage averages 3.3%. It's between 2 and 4%. And so this is why we're seeing delinquencies down despite a 7% mortgage rate. When we hear people saying mortgage rates are at the highest, households going to collapse essentially, they're talking about at the margin. If I go and buy a house today, I'm those that are at the margin. I'll buy a house, I'll be forced to pay 7% interest on that mortgage. But those that have fixed rate mortgages over a 30-year stack, because we've seen trillions of dollars in refinancing during 2020 and 2021, they're all fixed in at about 3.3%. They're just harnessing yield. So we're seeing a situation where you have net cash of 1.8 trillion. You're seeing delinquency rates on multifamily and commercial at their lowest rate. They continue to decline despite 7% mortgages, in excess of 7% mortgages, because of the fixed rate boom. And so as of right now, when we break it down, you can see that the credit quality today is far different than when it was back in 2008. 2008, you've seen foreclosures and bankruptcies already well rising in 2006, 2007. Today, they're barely a blip on the chart for the reasons that I mentioned a moment ago. No exotic loan credit, all fixed rate mortgages, 98% are fixed rate mortgages, all fixed in at 3.3%. The labor market, if we want to have a look at the labor market, if we look at the participation rate, at about 62.3%. This is off of 2007 at 66. It's down about 4 points. 4% of the entire population has exited the labor market since 2007. It shouldn't be a surprise to understand why. 1946 was the beginning of the baby boomer generation after World War II. 1946 plus the average age of retirement at 61 is 2007. Once we hit 2007, we started to see baby boomers retire at a faster pace. 12 million workers exited the labor market. What does that do? It puts a massive squeeze on average hourly earnings. That's why average hourly earnings are screaming higher at the moment. We don't have enough workers. That's what the problem's been. As we get into a recession, we will see the unemployment rate increase, but I think it's probably going to be short-lived, and it's probably going to be at the margin. So if we have a look at the latest NFP, government jobs are down 20%. Finance and real estate is down 200,000, probably mostly in the mortgage market because of 7% mortgages. So that's essentially what we're seeing is the government's the biggest problem, and the consumer, they could stop spending, but as of right now, they have the capacity to continue spending relative to GDP. You're seeing revolving credit still at cycle lows. We can have a look at that right now. If we have a look at revolving credit, many people show a lot of misleading charts. So this big massive jump here was a change in the way in which we report consumer credit. It wasn't a real jump. That's just a change in regulation. But a lot of people are showing the nominal growth in revolving credit and saying we've got a big problem. The problem with that is if I have a look at this relative to GDP, first and foremost, this hasn't grown much in a number of years. But if I look at this relative to GDP, you'll see that we're still at cycle lows. So if I go add that in there, if I divide consumer credit by GDP, what we'll see is that this is still at cycle lows. So the consumer, although credit is increasing, we're still at cycle lows relative to where we were. And that there is not actually the peak. It actually goes a little bit higher, but because of that adjustment, you don't actually see it. The peak is over here, which would have been up there somewhere. Anyway, what we're seeing is that revolving credit is increasing relative to GDP, but it's still at prior cycle lows in terms of as a percentage of GDP. And as you've seen a moment ago, we are seeing a situation where unemployment is increasing, but the vast majority of jobs are still being held down. So I'm pretty encouraged by that. Back to Jack's question, what is my view on a recession next year? Look, I think I'm definitely a concerned citizen, let me tell you that much. I think the consumer is in great shape, which made this year particularly difficult. Consumer's in good shape. You're starting to see a repricing in a lot of those consumer brands. So Crocs today, I don't know where it is, but it was up earlier anyway. If we go into the daily, Crocs today is up 16.5%. It's starting to Crocs is trading. It's going to do between 10 and 10.30. You can see it over here. We're going to do between $10 and $10.30. I think is what they guided. So it was trading before today at about 6 times earnings. It's a very, very, very cheap company when the industry average is about 11 times earnings. We are seeing markets make lower lows, but slowly but surely, a lot of these assets are starting to price higher. Crocs is 68% off those lows. I think there's a lot more companies in the portfolio that might start moving, but you can start to see that well-run, solid businesses focused on the consumer, they are performing quite well. So as of right now, my expectation has been to invest in those type of businesses. If we went into a recession, let's go back to the year 2000. Not that today is exactly like 2000. I think we have flavors of the pandemic back in 1917, the Spanish flu. We had a depression between 1920 and 1921, and then we went on a massive boom. The Roaring 20s, which was 1920 into 1930, we had 4 recessions. You can't see it on a price chart because Ben Strong, who was the Federal Reserve chair at the time, he was the first Federal Reserve chair, 1914 up until the day that he died, I think in 1928. Ben Strong continued to do at-the-money purchases, quantitative easing. In 1940s, after World War, during World War and after World War, we've seen yield curve control. Both of those periods, I believe, Mariner Eccles in 1940s and Ben Strong in the 1920s, that's the only way in which we get out of this problem. So as of right now, when you're looking at markets, this is not driven by a recession. I'd argue that that's pub talk. What it is driven by is just multiple compression. So if we have a look here at this chart here, what we see here is that earnings have held up really well, but the share price of the S&P 500 has continued to drop lower. What that is a re-rating of risk. The valuation is getting cheaper and cheaper and cheaper. Earnings are remaining quite robust over the past year. And so why is that happening? Well, it's happening because the neutral rate is increasing. So let's have a look at this really quickly. Let me just get a blank piece of paper here. Let's have a look at this really quickly. Let's say that the neutral rate, so the Federal Reserve just raised interest rates from 3.75%, that's the overnight rate, to 4%. So I could put money into the overnight facility and I can collect between 3.75 to 4% on a day-to-day basis, and the annual return will be 3.75%. Now, if you go back 1 year ago, the S&P 500, I think, was trading up around, it was trading up around 35 times price to earnings. Now, if I take 1 and divide it by 35, that gives me a 2.8% yield. So equities a year ago were trading at 2.8% earnings yield at a 35 multiple. So at 35 times earnings, that equals 2.8% earnings yield. Today, with bonds, the risk-free rate, the overnight rate of 3.75 to 4, gives me much more return for owning U.S. Treasuries over equities. What does that mean? The price of these equities have to drop lower with a higher neutral rate. And that's what we've seen. Now, with the 2-year bond yield at about 4.7%, earnings yield at about 5% would be equal to equities, would be about a 20x multiple. We're in and around, I think, somewhere around 18, in and around that region today. So we're slightly below there. Equities are slightly better value despite the bond sell-off on a 2-year bond yield basis. So when we see the neutral rate increase, equity multiples have to re-rate lower to fairly reflect relative valuations. And that's what we've seen all year. Bond yields have increased, the valuation has come down, and we're now at the point at which I think we could go a little bit too far and break something, and we could head into a recession. But that recession, in my view, will be driven by government expenditure, austerity in government expenditure, or some sort of pressure on the Federal Reserve to start monetizing the debt. I do think we're likely to see something like what the Bank of England done a couple of weeks ago with the pension funds on the long end. They need to fight inflation, so they continued raising interest rates on the short end, but they started monetizing the long end to free up liquidity. The Bank of England's balance sheet still grew, so it was a it's yield curve control, but it was a quasi quantitative easing. They supplied liquidity to the market, and that liquidity was taken and recycled into some other part of the market. That's what I think the U.S. government or the Federal Reserve and the U.S. government are going to have to do. So next year, is there a possibility of a recession? Yes, absolutely. How does it look? It's really, really, really difficult to know. I'm somewhat surprised to see 57.4% growth here from Crocs on the latest quarter, doing $1 billion in sales with the current environment that we're seeing. But at the same time, the consumer is still in great shape and continues to spend. Etsy also had a very robust quarter today. I say Etsy just because I had a look at it last night. I think it's doing quite well today as well, up 15% on better than expected results. A lot of durability there. Booking was also very strong. Again, these are all discretionary brands. Booking was also very strong on its earnings. Marriott, outside of what happened in China, if you look at the US and Europe, was still very strong. China's in zero COVID. So we have a situation over in China where the problem is travel is just non-existent. I'm going to get into some of the questions now. I hope I answered the question, but I'm going to fire away with some of these. Tanner, you added some Zim. Oh yeah, I wanted to talk about that. So Zim, I added Zim yesterday. I put 3% into Zim. And the reason why I put 3% into Zim is, let's have a look at this really quickly. Zim is a shipper, but Zim is trading on a really bizarre valuation. So if we have a look at Zim's valuation, I think we paid $23. So in and around this area, plus or minus 1%. $2.7 billion market cap. Now, when we pop on over here and have a look at the balance sheet, and we have a look at the debt, they've got 79 million in, it's a little bit more, 79 million in long-term debt, current portion, and 164 million in long-term debt. That's $245 million they have in debt. It's roughly $2 per share in debt is what they have. They have 120 million shares divided by 240 million in long-term debt. They've got $2 per share in debt. That's essentially what the company has. The rest of the total debt that's counted here at the bottom is all capital leases. Capital leases can be restructured. They don't have interest coupon, and it's an operating expense. So that's not debt. That's operating leases. So the debt's only 245 or $2 per share. If you look at the cash position that they have, it's 3.3 billion, which is $27 per share. So if you take $27 per share minus your $2 per share, it's $25 per share net cash that they have today. Now, if we have a look at what the estimates are next year, Masaryk reported, and they said we're going to see declines of about 2 to 4%, but they reaffirmed their full year guidance. Now, when I'm looking at Zim and I have a look 2023's estimates, if they can reaffirm this cash flow of 1.357 billion, that's another $11 per share in cash. So I have net cash of 25 plus 11. So I've got $36 per share in cash by the end of 2023 for owning Zim. They've got a shareholder remuneration policy where they're paying out between 30 and 50% of net income, or EBITDA, as dividends. So the way in which I looked at Zim is, you don't need the industry to bottom out for this to work, because over the next 12 months, we should be expecting about 25 to 50% in dividend payout. If they can reaffirm their guidance like Masaryk did, we're going to see a situation where these guys are going to generate another $11. So we get about $36 in cash per share by the end of 2023, and we pay $23 for it. So I was looking at it, and if China does open up or ease a zero COVID policy, demand would increase a little bit. If we can avoid some sort of deep recession next year, to keep it quite shallow, Zim should be able to do perfectly fine with the big massive dividends and possibly some share buybacks. I could see Zim doubling over the next year from current prices. But that's essentially why I added Zim. It just got to a point where it was bizarrely cheap. I looked at this in the past and I owned it in the past, and then tensions started to increase between the United States and China over Taiwan. And I got out of it luckily just in time, and it sold off quite aggressively. It dropped 50% since then. But at this stage, paying net cash $25 after the debt that they have, paying $23 for that, and the option, if they reaffirm guidance next year, another $11 in free cash flow per share, $36 per share, plus the remuneration in terms of dividends, we've got a margin of safety of 25 to 50% on the downside based on those dividends. And if we're right, the equity appreciates, hopefully we bottom out pretty soon. That was essentially why I went with Zim. It's a 3% position. I don't plan on building it out any further, but I do think it's bizarrely cheap. It's not systemically at risk. So there's a lot of companies that might have a lot of leverage with higher interest environments. They might be in trouble, but Zim is not in that category. And that's essentially why I bought it. the equity could go down over the next couple of months, could be down 20%. And it might continue to show in the portfolio 20%. But as we get those dividends, that'll go into the cash portion of the business, or the cash portion of our portfolio, and we'll be able to reinvest that capital into other parts of the portfolio. So that's why I bought Zim. It just got to a point where it got so cheap it was hard to ignore. Hey Rob, let's see. Same LG. Regarding GDP and government spending, can you touch on Russell Napier's article, and how can we as an investor benefit from that? Yeah, I actually have that up. Russell Napier is the only other person that shares the same view as me. My view is, and we've done 3 live streams, so the live stream 1 and live stream 2 go over in a little bit more detail about exactly what Russell's talking about. So if I actually go over to Canva, I think I have it in Canva, I'm not sure. Yeah, so it should be here. I done a presentation a little while ago. There's some charts in here. I just don't know where these are. So this chart here is very important. I believe we're repeating 1940s, 50s, and 60s. We have very high debt to GDP, right? So this is essentially what Russell Napier is saying. We have very high debt to GDP. The only way in which that comes down is the US government default on their debt. And I think that's the worst outcome that we could possibly have. The whole world would pretty much end. Like, when you've got the world reserve currency essentially blowing up on debt, we've got no medium of exchange. It would take years to clean up the mess. We'd go into a global depression, and it doesn't have to happen. We know it doesn't have to happen because during the 1940s, we have a solution. So we have debt to GDP at 121%. The only way we get it down is debt default. That's not a good option. Or inflation. Inflation is not necessarily bad. It's really bad if you're in the bottom 20% of the population. But if you can pull yourself out of there, you'll be perfectly fine. It's really good if you have lots of debt, if you have a lot of fixed rate debt, and if you have government debt. And that's where it's really good. So Russell Napier's view is that the US government will continue to borrow more money. So they will widen this deficit even wider than this here, and they'll keep spending on capital expenditure. And he's suggesting that we're going to get 6%. Let's have a look here. He is suggesting that we're going to get, or this is a perfect scenario, and I agree with him. This is really where my view is. I'm just looking for the numbers here. Say 2% real growth. So he's talking about inflation. So he's talking about 2% in real growth on average due to fiscal spending. And anyway, it's 4 to 6%. There it is there, 4 to 6%. We'd probably be around 4 to 6% on average with inflation. That would be the inflation range. So you'd have between 6 and 8% nominal earnings growth. And that would be about 2% real, 4 to 6% inflation. And so that's how you get the debt to GDP roll off. In the very near term, what we would see is the US government would have to monetize this. So this is the balance sheet back in the 1940s. Let me zoom in here. That's 1942, 1943, 1944, 1945, 1946. This is the Federal Reserve's balance sheet. It just got bigger and bigger and bigger. They don't yield curve control. They kept buying T-bills. The US government kept spending and doing fiscal spending. So you look at the CHIPS Act, $43 billion, those type of programs. That's what Russell Napier is touching on. The CHIPS Act, infrastructure bills, all this sort of stuff. The Federal Reserve would monetize it. Their balance sheet would get really big. Inflation would grow. The US government's balance sheet would get very big. But over 10, 20 years, you would see government tax receipts grow at a faster pace than debt. And eventually, tax receipts get so big that they dwarf debt. And then we end up in a situation where debt to GDP, and it should be here on one of these charts, debt to GDP would end up getting back down to about 30%. And that's where the real trouble happens. And that's what Russell Napier is saying. So where we are as of right now is keeping your money in a cash deposit doesn't make a lot of sense because banks are not passing it on. Right now, we've got 3.75 to 4% on the overnight rate. Banks are collecting all that money on your deposits, but they're not passing it on to consumers. They're keeping it as net interest income. So they're not passing that on. So if you hold cash, it's not a good investment vehicle. With inflation being higher than bond yields, bonds are going to make a negative real return. I personally think that equities that have some sort of productive, tangible use, maybe a tight market, pricing power, those type of companies over the next decade will do very well. And that's essentially what Russell Napier is arguing, is that you see this big, massive capital expenditure boom driven by the Federal Reserve monetizing debt. And eventually we're going to see inflation peter off in like 15, 20 years. And that's when the problems start. So a lot of people ask, well, what happens to the Federal Reserve's balance sheet if it gets up to like $20 trillion? Well, if you took out a mortgage, you pay that monthly for 30 years and then the mortgage disappears. Well, you can run off the balance sheet. The Federal Reserve can do exactly the same. They can bloat their balance sheet and they can let it run off over time. And that's how the Federal Reserve get their balance sheet down. And that's how the US government get their balance sheet down. But inflation is a tax. So essentially what we're orchestrating is a higher tax rate on the population without calling it a tax rate. Inflation is a tax. So that's essentially what Napier is talking about. The CHIPS Act is an example. We've got some exposure there with Applied Materials, which sell machines to develop chips. Now, on the latest quarter, it's very easy to see who's actually reading this stuff and who isn't. Applied Materials is an interesting one because in the latest quarter, they downgraded Q4's guidance by 400 million. And they downgraded it because the US government, they asked every US citizen working in China on critical semiconductor or AI infrastructure to choose between their passport and their job. And over in China, every single person that had a US passport, they quit their job. They felt their passport was more valuable. Chinese sector just collapses. So with Applied Materials, their backlog of order doesn't come down, but because you have that supply chain issue over in China, semiconductor space, it caused a big, massive challenge to Applied Materials. That'll average out over the next couple of years. It doesn't really matter. But these guys sell machinery for building or for producing chips. So as you build new fabs in the US, Europe, in different territories, Applied Materials will be selling machinery for those different fabs. At the same time, Micron are applying to take some of that funding to subsidize manufacturing of new fabs over the next decade. And so these type of businesses will be directly impacted by that funding on the CHIPS Act. And that's just the first act. So that's one example. But there's likely to be plenty more on infrastructure, rail, all that sort of stuff moving forward. So yeah, that's how we're likely to see it, is a big bloating of debt. This is the Federal Reserve's balance sheet back in the 40s, and then that just runs off over time. And if you look at the 50s and 60s, like Russell Napier saying, this is a big boom period for the next 15 years for investors. If you go back and you have a look at the performance, like it's not like, I think a lot of people are very short-term focused, but if you look back in the 1950s and 60s, this was a great time to be in 40s, 50s, and 60s. As you came out of the 40s, 50s, and 60s, this was a great time to be invested in equities broadly. The real returns were a little bit lower because inflation was quite hot, but it protected your capital and gave you a real return. So I believe that Russell Napier's view is correct. That's the one I've been holding all year. This year has been very difficult, but I do think when you're looking longer term into the decade, I do think this is the path of least resistance, the only way in which you delever. That's sort of how I see it. Hey, Caesar, great to see you. Hope to hear your thoughts on Amazon earnings and outlook. Look, everyone's talking about a recession, but let me put up some of the numbers from Amazon. 25% growth year on year in advertising. Is that good? Is that bad? Well, advertising is highly cyclical. And this is was it a $32 billion run rate? It's not a small business is what I'm trying to say. 25% growth in an advertising, which is highly cyclical at I think it's 30, I could be wrong. It may even be higher. I can't think of it off the top of my head. It's growing. It's well in excess of $30 billion anyway, growing at 20%, 25% year on year. AWS grew at 28%. I think 1P, first party grew at 9%, third party grew at 16%. Across the board, we've seen fantastic growth considering the circumstances. The challenge for Amazon is obviously wages. So margins get compressed because you've got 1.7 million workers. So inflationary pressures due to wages and due to energy. And that includes stock-based compensation and energy as it relates to the AWS business. So what we've seen was between labor and energy, about 2 points hit to the margin on AWS, and then the rest of it was just timing of contracts. As of right now, AWS is just predominantly US based. It's only starting to scale into international markets, so that'll give you an idea of just how big this business can be. It grew 28%. A lot of people are disappointed by that, but given that a lot of businesses in the tech space are talking about scaling back capital expenditure, to grow 28% year on year is fantastic. The margins, it was 26.5%, I think, down from 30%. It is going to fluctuate due to timing of specific contracts, but energy, obviously higher energy costs is obviously a problem. A little bit of stock-based compensation as well. Those growth numbers from 1P, 3P, advertising and AWS, I thought that they were very good. It's trading at 13 times enterprise value to EBITDA when you add back the depreciation and amortization. Back in 2017, on a conference call, if you get the transcripts, I think it was Q3, this quarter in 2017, Jeff Bezos was given a round of applause for a fantastic quarter. And his response was brilliant. His response was, today's numbers were already baked in 3 years ago because they had increased capital expenditure 3 years prior to that. And once that capital expenditure rolled off, you started to see the fruits of the return on that invested capital. Well, the last 2 years, you've seen capital expenditure just absolutely balloon over at Amazon. $65 billion right now. It's massive. There's very few businesses that are doing $65 billion in sales, let alone $65 billion in capital expenditure. So as capital expenditure rolls off, we should start to see the benefits of an awful lot of that CapEx roll into return on invested capital and free cash flows growing out. Capital expenditure comes down, free cash flow goes up, incremental growth on the top line. 40% of capital expenditure is going back into AWS. It's growing at 28% on the latest quarter. Is that good? I mean, it's at an 84 or $86 billion annual run rate. It's huge. Like, these are big businesses. They're not small businesses. And they're growing at high double digits in this market environment with technology where it is, with the tech sector where it is. It's really, really, really impressive. So yes, the equity price went down. Another part of that reason was foreign exchange. So here's the problem. When you've got a big multinational business, let's say you make 50% of your money in the United States and you make 50% of your money in the rest of the world. Well, if you report in US dollars, this part of your segment's fine. Now, if the US dollar goes up 17% across a basket of currencies internationally, that's depreciating your reported sales. This number here could actually grow, but it would show up as a decline in US dollars because of the massive strength in the US dollar. So we have an issue with high energy costs, labor costs, timing of contracts, and at the same time, on top of that, we had the dollar increase 10% over Q3. So the dollar will peak eventually and it'll roll over. That'll become a tailwind. Energy is moderated to some degree. So over the next couple of quarters, as long as it doesn't scream out of control, we should start to see that normalize a little bit. And hopefully they have pricing power. They can pass on those costs, which remains to be seen. Longer term, there's very few businesses like Amazon that exist. And the reason why I say that is Amazon if you look at their advertising business as an example, this is just a data machine. They've got a 10% conversion rate on their advertising. So if you look at the normal website, an average website is 2%. Amazon are getting 10%. And that's due to the amount of information that they collect on their customers through Alexa. They just bought Roomba. The interesting thing about Roomba is as the iRobot essentially hoovers your floor, it also maps out the floor plans. So you get an idea of the floor plans, maybe to go into furniture or whatever it may be. You have an idea from Whole Foods what your basket looks like. You have an idea from Alexa what your preferences are. They've got such fantastic data on the consumer that they're like all of these auxiliary businesses are just absolutely killing it. And when you look at advertising and when you look at AWS, those two businesses are a massive growth engine for the business. It's to combined, I think they're about $140 billion or $120 billion in and around that region of revenue, high margin revenue, growing in excess of 25% year on year. And they continue to drive revenue. The interesting thing is most of the revenue in both of those businesses is predominantly in the United States. So as they start scaling up that revenue on those businesses internationally, we're going to start to see a big, massive ramp up in terms of Amazon's revenue and earnings. So right now, look, there's a lot of challenges in the market, but I think that while there's a lot of uncertainty, for me, the way in which I want to approach it and the way I have been approaching it is I just want to keep adding to my positions, knowing that these businesses are quite solid. Interest rates have limitations. multiples do have a floor, and the consumer's in good shape. And that's sort of how I look at it. So in the near term, yeah, it's hard to stomach. It's hard to stomach the volatility, but I think over the next couple of years, it should average out. Rob, Overstock has been in free fall since the start of the year. Do you not feel you were a little rash, reckless, building your position whilst it was in the 60s? So I didn't build a position in the 60s. I added this. So let me show you. If you look at all of the purchases of Overstock, I actually bought Overstock in November 2000, 2020, not November 2000, November 2020. I paid $61.87. And that rallied all the way up to $112. And I cut it, I don't know by how much, 30 to 50%. And I took some profits, 75% gain. And I done nothing. I done absolutely nothing with it since then. When it got to $54, I added more. And the reason why when it got to $54, I added more is because at the time they had $500 million in cash. And during an upcycle, they'll do about $100 million plus in free cash flow. And I felt between the cash and the free cash flow, I was essentially paying fair value at $54, and I got my DC Ventures for free. So I bought some at 54. I bought some more then when I got down to 48. I bought some more at 56. I bought some more at 39, and I bought some more at 26. And I haven't added any since. My average cost is $44. That's what my average cost is. But I've been in this for a while. I've been in this for a long time. Did take a little bit of profit, but it was on a much smaller position relative to what I have at the moment. So the question is, do I think I was a little bit rash or reckless? No, because I'm not trading Pokemon cards. I own a business. And if you look at the performance of Overstock year to date, sure, the profits haven't been massive, but it's remained profitable. And on that, there was actually a notice to say that restricted stock units weren't included in their Q1, Q2, which affected their income. I got to look into that a little bit more. But from an operation perspective, the operating cash flows have been positive to the tune of about $20 million. Q1, Q2, Q3, I can't remember off the top of my head what it was, but the company's profitable. It's my view that the e-commerce business that they have, if the revenue could drop 50% and they'd still make money because of the nature of the business, right? It's a business that essentially is connecting a consumer with a mom and pop store, and the mom and pop store does everything else and they get a small commission. That's essentially what it is. And they build up the rapport with the customer, and that's essentially where their I hate using the word moat, but that's essentially where the competitive edge is. That rapport that they build up with the customer. So when you're looking at Overstock, in most market environments, the balance sheet's going to be perfectly fine. As of right now, you got $428 million on the balance sheet. It's about $9 per share in cash. It's trading at $21.27. So half of the current share price, a quarter of what I paid for it was cash. And during an upcycle, I think that this will be doing in excess of $100 million. The problem, what happened with Overstock, interest rates for mortgages went from 3% to 7%. House prices have rolled over about 5-7%, not massive. That's off a peak. It's still up year to date, year over year. But what happens is home and furniture is correlated to home sales. Home sales fell off a cliff. So that business slowed down massively until it normalizes. Either demand normalizes at a higher interest rate, or those interest rates come down a little bit over the next 1 or 2 years, down towards about 5%. And then you'll start to see demand increase and you'll start to see growth. As of right now, over the past decade, we've structurally underbuilt 4 million houses. Today, we have 20 million houses that are up for renovation. By 2025, that number increases to 25 million. That's based on the age of the house between 20 and 39 years of age. And so both of those metrics says that over the next number of years, e-commerce, Overstock's furniture business will be perfectly fine. So I don't think I overpaid. There was a couple of things that caught me by surprise. Mortgage rate at 7%, complete seizing of the housing market. I didn't anticipate interest rates would get to where they are. So obviously, if I had that crystal ball earlier this year, maybe I wouldn't have went as aggressively in. But we haven't even began to talk about T0, 55% ownership in T0. It's fully funded with $250 million. And you've got a management team ready to execute that were the original founders of ICE Markets. And so over the next couple of years, as they build that business out further, which I think is going to be very exciting. So if you think about raising money for a real estate syndication, right? So there's a problem because it's a closed-end fund. If I want to raise money for you, it's going to be a closed-end fund because I'm going to buy illiquid assets. So you're going to give me money, we're going to put it into the fund, and it has to stay there for 10 years. That's a problem if you need the money. So what T0's platform does is you look at venture capital, you look at private equity, you look at real estate syndication. It provides us liquidity in the secondary market for people that want to exit, let's say, closed-end funds. In tandem with that, you also have access to public markets. That's what they're solving for. There's no platform. It's very unique in that regards. The TZROP token, which is doing the distribution, that's got the brokerage license. And so that's what makes that platform very interesting. If you have the right high-grade human capital, that scales up a lot. You've got the co-founder and former CTO of ICE Markets as a board member, and you've got the CSO of ICE Markets leave his job and become the CEO. Both of those have been at ICE Markets for over 30 years. ICE Markets Intercontinental Exchange is a parent company of the New York Stock Exchange. So that's a business. I'll use David Goon's words. He thinks it can be bigger than ICE Markets. ICE Markets is a $60 billion business. So we get that for free. And that's just one of a whole portfolio. In there, you've got Bit Global. Whatever your view is on CBDCs, it doesn't really matter. We own 84% of Bit Global, which is a premier platform for CBDCs with 7 contracts with central banks around the world. That's a zero. We paid zero for that. You have smaller businesses like Minds, decentralized social network. You've got Grain Chain, which is solving for supply chain issues within the agricultural market. You've got all of these different smaller businesses like Medici Land Ventures, which is using blockchain in order to solve for swapping titles of deeds to houses, essentially. All of these businesses are priced at zero. There's 20 of them in there. 19 other of them is like Lucky Dip. They could end up getting a little bit of M&A deal, bought out, IPO, whatever. It could generate a couple $100 million in those 19 different companies, small buyouts here and there, or they could go to zero. It doesn't really matter. T0 is the one I'm very interested in because if that IPO'd in, let's say, 3 to 5 years at a $10 billion valuation based on the equity we own, we get about $127 in value in overstock per share just on that IPO at $10 billion. So that's where I think the value is. I think I paid a fair price. I think the fair price of the company based on normal, like right now, we're in a recession within the housing market. Well, home builders are essentially in a recession. But as we get out of this and get into the normal cycle, then that's when we'll be able to sell our shares. It'll take a couple of years. But when liquidity comes back to the market, and we start to see the housing market, like people live in houses. For some reason, people think that we're not going to build houses anymore. We're not going to buy or sell houses. Demand will adjust and spending will continue. But in time, that business will start to recover. I think it'll do in excess of $100 million based on the growth it can do cross-border into Canada and then moving into different verticals, whether it's going from furniture into home or whether it's going from value where they currently are into luxury and competing with Wayfair. There's so many opportunities that they have. So I don't regret paying for it, building it out. I think it's a huge amount of opportunity here. But there's certain things that happened over the past year that I didn't foresee, over the past, say, 9 months or 10 months that I didn't foresee, like the mortgage rate getting in excess of 7% and just a seizing up of that market. I didn't expect that. That being said, I'm still very happy with what I paid for it. It's one of my biggest positions in my personal portfolio and also in the eToro portfolio. This is the same weighting. So JJ, I think it's JJ or IJ. Apparently central bank purchases of gold have exploded, thought to be Russia and China getting out of US treasuries and putting their money elsewhere for fear it gets confiscated. Maybe, but if you look at the gold market, what's interesting about the gold, like here's the thing, asset confiscation can happen all the time. With the gold market, it's really interesting. If you take it out of the system, it's devalued. It's not worth the same amount of money. If it's within the system, held at a specific, I'm not sure what the name of them are called, but these people have licenses to hold gold within the system. If it's held there and it's secured at those deposits, those vaults, it's got a premium. It's a reserve asset. Can't think the name of it, but it's still within a centralized system. I don't know. I can't comment. There's a lot of speculation on a lot of things, but I think that's essentially it. Current thoughts on Meta. No matter how I look at it, it just seems incredibly mispriced. but I keep seeing the most negative comments and the stock keeps dropping. I'm starting to think I might be wrong. So here's the thing with Meta, the latest earnings, like I mentioned it earlier, on a constant currency basis, they grew 2% year on year, engagement improved, and they continue to grow out the numbers, which is absolutely fascinating to me because there's already 2.9 billion people on their platform. The thing with Meta is the reason why everyone's panicking is about a month or two ago, Zuckerberg said, we're going to see a 10% reduction in staff count. We're going to cut back capital expenditure. Macro environment's a little bit difficult. They were guiding at the time $28 billion in capital expenditure. So that's what we're anticipating. Maybe a 10% reduction in staff count. 28 billion goes down to maybe 25. Free cash flow increases. Maybe more buybacks today because the share price is bizarrely cheap. And we'll look at just how cheap it is in just a moment. But that's essentially what the market was expecting. Earnings come out. They beat on the top line, missed on the bottom line. Why did they miss on the bottom line? Capital expenditure was $9.58 billion. It was at a run rate of $38 billion. They upgraded the expectation for capital expenditure from 28 billion to 38 billion. And this was after expecting that we were going to see a reduction in headcount, which actually grew 28% year on year. So what's happening with Meta is, I think there's just a massive loss of faith in Zuckerberg, because with Meta, and I've never really, I'm not a big enough investor really to have a say, but there's two classes of shares. One has all the voting rights and the other one doesn't. And, Zuckerberg has all the voting rights and he's decided this is what we're doing. We're going after the metaverse. A lot of people are concerned about where all this capital is going, but the metaverse is really not that difficult to understand whatsoever. It's just a reiteration of what the internet is. It's a different immersed sort of idea of what the internet is. What they're spending a lot of the money on into the end of 2023 is actually Reels. So what ended up happening with Facebook is their earnings, the revenue on the top line got hit because of changes to Apple. And when it got hit, what Facebook realized is the main point of failure to their business was Apple and Google. And it was completely out of their control. The performance of their ads started to dwindle. And so they needed to change the infrastructure that they have. They're reinvesting to build out that infrastructure so they're not reliant on Apple or on Google moving forward. If they're successful, we'll see a normalization in revenue and earnings. Zuckerberg's saying it's hundreds of billions, if not trillions of dollars. He has to execute first. What he's trying to do with Reels and the AI and the AI for sharing content, like learning about specific users and then sharing specific content. What he's trying to do in 2 years took ByteDance 8 years to do with TikTok. That's where an awful lot of the capital expenditure is going. That'll start to moderate at the end of 2023, and then Reality Labs starts to increase in capital expenditures. But if they're successful with Reels by the end of 2023, it could be a very interesting market environment. So let's just talk about how cheap it is. So I think the reason why Meta is collapsing right now is, let's see, if they increased their guidance on capital expenditure was between 34 and 39 billion, but the annual run rate's like 38. So if we have a look at 2023, we go down to capital expenditures. 34 billion is the low end. It was expected to be 28. 34 to 39 billion is essentially what they guided. And if you annualize the latest quarter of 9.58, I think it was, it works out at about 38 billion. So it's a lot higher than where it was. What that means is, look at the free cash flow goes down to 18 billion, net income 13 billion. So net income, free cash flow come way down. Is that really that bad? I mean, as of right now, look at the market cap, it's only 240 million. It's 240 million. You're making $24 million. Was that $24 million in net income? It's a 10 PE at current prices with capital expenditures of $35 billion. That's insane. And so these are sort of voluntary decisions to increase capital expenditure. So it's cheap outside of those decisions, but they could scale back that capital expenditure if they wanted to, but I don't think they will. Now, this is how cheap it is even further. They've got $41 billion in cash, and they've got $9.9 billion in debt. So the net cash is $32 billion. So $32 billion divided by your 240, you're looking at what, 12%, something like that? 13.3% in net cash relative to the market cap. So it's trading at 10 PE and it's got 13 it's got 13% of its market cap in cash. It is very cheap, but the two classes of shares and the big massive surprise on capital expenditure has absolutely crushed the stock. You know, if you go back to 2000 and when they bought Oculus in 2014, they started to talk about this idea of the metaverse, and then they have an investor deck from 2016 where they start talking about their timelines. And right now is where they talk about AI and moving forward with AI, and that's essentially what they're spending money on. So Zuckerberg's been talking about this for a long time, but I just think given where the current macro environment is, there's a lot of uncertainty. People don't really know what's going on. It's sort of like a lick your finger and it's a wind test. I think there's a lot of people uncomfortable with the amount of money they're spending on capital expenditure, including myself. But at the same time, that's why I put it in a diversified portfolio. And if he's successful and they can get back to where they were without the need of, or without the reliance, that single point of failure with Apple and Google, I mean, it could be very, very, very interesting. But that's why I diversify. Go back to 2021 and everyone said diversification's for idiots. Market's going up, you just have to buy anything. But when the market goes down, you begin to realize, holy smokes, even the biggest, most stable cash flow producing businesses can get hit 70-80%. Which I think if you go back a year ago, nobody would have predicted that, not even myself. So yeah, Melvin's saying, I remember a while ago you put together a portfolio solely based on screener with no further due diligence. Have you kept track of that? I have. And I used to have that under a video, but I didn't know how to stop people changing the bloody thing. So I closed it. A lot of people let me just pull it up. A lot of people kept changing the spreadsheet, which was very frustrating. But I do have that. If you give me one moment, I will find it and we'll have a look at it. It's probably not doing very well with what happened in Europe because I adjusted for US dollars and Europe got absolutely smacked. 7 companies were in Europe and there was a lot of exposure to semiconductors. So right now it's at 28.98% down. Well, it's a little bit better than the QQQs. And there's a lot of semiconductor exposure in here. And I think there's a lot of British, and it's all adjusted for the currency, by the way. So yeah, 28.96%. And it's coming up towards the first year, but that was a very difficult year for that more specifically. But yeah, it was definitely something that I'm going to dig into in December after the first year. But yeah, talk about a good year to start on that one. 7 companies from Europe, Germany, UK, and France. And top heavy, there was about 40 or 30% in semiconductors. I think you'd need to give that 3 years though, to average out. I don't think a 1 year time frame makes sense. But yeah, I'm still following it. It's just sitting in my Google Excel. What is the Fed balance sheet and why does it matter? Why does the Fed's balance sheet matter? Well, the Fed's balance sheet is the total assets that the Federal Reserve own. Why does it matter? Because the Federal Reserve mint what's known as reserves, and these reserves can be used for 2 things. They can be used to back a loan on a commercial bank's balance sheet, or they can be used to purchase things like treasuries or mortgage-backed securities. Now, the Federal Reserve did go into corporate debt, and they did buy corporate debt back in 2020, but they're not supposed to do that. So that's essentially what the Federal Reserve do, is they create these reserves and they can use that to purchase treasuries, mortgage-backed securities, or back loans at commercial banks. So I could issue, as a government of the United States, I could issue a bond and the Federal Reserve can buy that off me. And then this asset, right? So one man's debts, another man's liabilities. That asset would be a liability of the US government, but it'd be an asset to the Federal Reserve. So it goes on their balance sheet. And that should produce a coupon. Now, if the Federal Reserve keep bidding up these, the coupon goes down, so the interest rate goes down as well. So the Federal Reserve's balance sheet it's the same as a company's balance sheet, assets, liabilities, but what they do with those assets and liabilities matter. Right now, what they want to do is shrink their balance sheet. So instead of buying these bonds, they want to take the bonds that they already purchased and sell it back into the market. That's what they want to do right now. And so because nobody wants to buy them, they're putting them on the market for sale. And the interest rate, the percentage yield is going through the roof. Because when you look at a bond, let's say a bond is issued at $1,000, which I think is the normal stock for a bond. I don't know what's happening to my camera, but let's say a bond is issued at $1,000 and it has a coupon of 10%, it will generate $100 every single year. Now, let's say I have this bond and it's a 20-year bond and I want to sell that bond right now. I need to get out of it because I have a better opportunity. I've got this stock over here that's going to go up 10x straight to the moon. It's a better opportunity, essentially. I need to get out of it. I might discount this bond because maybe nobody really wants to buy it, so I need to discount that bond. So that bond is now worth $900, but it still pays out $100. So when inflation is increasing and nobody wants to buy your bond because of that inflation, the Federal Reserve have to keep discounting their bond. What happens to the yield? It goes from 10%. Will the yield on that be 12? I don't know. My maths is terrible, but it'll be 100 divided by 900. It'll be 11.1%. So this bond would now produce 11% in yield to whoever bought it for 900. And that's what we're seeing at the moment. Nobody wants to buy the bonds, so they're being discounted by the market. The yield is going up because the coupon's still the same, but it's being discounted because nobody wants the bonds. And that's what we're seeing at the moment. So when you see those massive moves in bond yields, nobody wants to buy them. Federal Reserve is increasing the rate on the short end as well, which also impacts the curve, because when you look at a bank's essentially how it makes money is it makes money on the spread between the short end of the bond and the long end of the bond. The difference between both of these is the dollars that the bank would make on every loan. That's why we look at the yield curve. Now, if the Federal Reserve raise interest rates all the way up to here, and the yield on the short end equals the long end, banks don't make any money. So what's banks' incentives to lend out money? It's zero. I'm not going to lend out money if I lose money. So the banks will scale back that funding. As of right now, we've only just seen the 3-month minus the 10-year actually invert. So we'll see now if we get to a recession. But that's essentially the importance of the bank's balance sheet. Very rudimentary and basic stuff on bonds. So that was that question there. Sam, did I manage to see Wayfair's earnings? I didn't, but I'd say it was a train wreck. eToro portfolio website has 2 columns. One is invested, other is value. When you have 2.4%, why does it show that the value is 3% when the position is down a couple of percent? Well, some of the other positions might be down a little bit more. So it could be that the dollar amount today, another position might be down a little bit more, is essentially why it's showing that. James, Tupperware took another big tumble on earnings. Do you think this turnaround play will still work? Am I planning on investing my current cash in hand? Yes. 2 different questions. Answer is yes. And the first answer is it's challenging. So I actually have this up because I thought there was going to be a couple of questions about Tupperware. Turnarounds are really difficult, but you can make a hell of a lot of money if you get it right. And Tupperware is the exact same. It's no different to the idea in Transocean. Now, Transocean, okay, it's having a good day today. Nice, 15%. Transocean also reported great numbers. EBITDA was 100 million ahead of where we were expected. But let me just talk about Transocean and tell you why this idea was the same as Tupperware, but the outcomes are very different and the expected returns would be very different. I bought in my personal portfolio, I bought into Transocean in May 2020. $1.27 is my average price, is what I bought into it then. I've since added more. My average cost is higher, but that's where I started buying into it. It would be in the eToro portfolio since then, but the buy button was frozen. I couldn't buy it. I wasn't able to buy it on eToro. The minute that button eased, I waited until the fundamentals got better and I stuck it in the portfolio, and we have an average price, I don't know, of like 348 or something like that. So I originally bought into Transocean back in 2020. Let's talk about the fundamentals. They had 1.1 billion in cash and they had EBITDA of about $200 million. They had 1.3 million. That's it. That's all they had. Their day rates were, well, the utilization was very low. Day rates very weak, 250,000. They weren't making any money essentially. The only money that they were making in 2020 was money that they were making from depreciating maintenance capex. It was potentially a bankrupt company that had enough cash for 24 months into the future. And the reason why I bet in on this was they had $11 billion in shareholder equity. What is shareholder equity? It's assets minus liabilities. And then you have the book value of shareholder equity. They had $11 billion. And when you broke down the balance sheet, that was mostly assets. So when you excluded out the debt, which at the time was about $10 billion, that $10 billion, you exclude that out. If you had looked at the residual value of the company outside of that debt, I still doubled my money from what I paid for it. The market cap was only 650 million. It was priced for bankruptcy at the time. It was priced for bankruptcy in that 650 million market cap on 11 billion shareholder equity. The market believed, yes, there's value there, but the problem is there's no liquidity. It's completely illiquid. It's insolvent. That's what the market expected. I made a bet that it wasn't. Right after that, the share price pushed higher, and then it started to correct. And over here, we had this clown over at Bernstein decide to come out and destroy my day. I remember it was around, was it August? I'm not sure. Yeah, August. Chapter 11. Anyway, it was this analyst over at Bernstein who completely ruined my day. Doing very well, making some good money. And this guy comes out. They have 2 years of cash in the bank. And this guy says they should file Chapter 11, knowing that the common equity shareholder was not dead in the water. And we were starting to see energy prices actually start to recover. It went negative $37. It started to recover. What happens with energy is when the price goes so down, capital expenditure comes offline, the commodity reacts, supply demand economics, really basic stuff. Commodity goes up. Over a couple of years, commodity price goes up so much, capital expenditure comes back online. In that moment where it's really cheap, nobody wants to buy it. You have an opportunity to buy an asset where you make a hell of a lot of money. And then if they can escape that bankruptcy, finance their debt, they make a ton of money out the other side. Tons of money, like 5-10 times your money. Transocean was that bad. Cycle highs, we come out of this, we get 30%, which is a previous cycle return on equity on $11 billion. You're looking at $3.5 billion. $3.5 billion in net income. That's what we were looking at. That's not EBITDA. That's cycle highs if we can get there. That's not EBITDA. That's net income. You add back the depreciation, you're looking at $4.5 billion. Massive amount of cash on 650 million worth of market cap. They've since diluted, but even after diluting the market cap, even after today is only like maybe 3 billion. It's still a very cheap business. But what I'm trying to say is this company could have went bankrupt. It really could have went bankrupt. I had an average cost of $1.27. It got down to 65 cents. I should have bloody bought more, but I didn't because I thought that maybe it could have went bankrupt. And that was the concern. And so I didn't buy any more. And then it ripped higher. They started to get some new contracts. They refinanced some of their debt, restructured some of their debt. They were able to push out maturities. They done some good work in and around here to shore up more liquidity to push it further into the future. And then it kind of went sideways for a long period of time. But I was down about 50, 60%, whatever it was, I don't know, at one point, thinking that this company is going to go to zero. They pulled a rabbit out of the bag. And on the latest earnings, they done $278 million in EBITDA. Analysts were anticipating 170. This year, they done $1.2 billion in capital expenditure. 200 million is maintenance capex. $1 billion was for 2 new drill ships last December, and in May was delivered. Next year, that $1 billion goes away. Cash flow starts to increase. We got 1.1 billion next year in cash flows. What this latest earnings report showed us is the bankruptcy risks is pretty much in the near term, it's gone. The probability of success now for Transocean increased massively. So as of right now, average cost 127. I added more. I'm not sure what my average cost is. I don't even know what it is in the eToro portfolio, maybe 350, something like that. But anyway, the expected return, I think this is worth $25 to $30 if it played off. That expected return is worth the risk that we take. I started off this position at 2% of equity. I've built it up to about 4%. It's bigger today because the risks are a lot lower and we can start to see the light at the end of the tunnel. With Tupperware, it was the same idea. It's a bit of a turnaround play, heavily levered, and they got smashed this year. Absolutely smashed. Zero COVID policy in China, inflation, labor. They got hit on all fronts. A pivot from the consumer, from goods to services, absolutely everything hit them. And on the latest earnings, the reason why it was down 42%, and this is why we keep these positions small, You put 1-2% into these companies, and if it pays off and you make 10 times your money, it's 20% of your entire net worth. If it goes to zero, it's 2%, 98% of your portfolio in the solid businesses that you're investing in, Crocs, Taro Company, Pool Corporation, that makes up the difference. But these ones at the margin are where you can really make a lot of money. Transocean, which I think is only starting to run right now. I think there's another, anyway, I won't talk too much about that. But if we have a look at this here, and we go down to the liquidity position, I think this is ultimately where the challenge was. You have 100 million in the bank, and the company's covenants on their debt means that the leverage ratio needs to go from 4.5x down to 3.25x. So they need to delever. They might be able to get away with it. Why? They got into a large big box retailer, Target, but that was at the end of the quarter. We don't know the performance of that yet. They have an extra week as well. There's 53 weeks. So it's going to impact their sales in the quarter by 5% positively and 1% for the full year. So they might get enough liquidity to get past this. So where we are as of right now with Tupperware is, in my view, we're at this juncture here where if they can pull it out of the bag in the next quarter, we can recover. If not, this sucker is going to go down. And we size the bets according to that. If they can pull it out of the bag and they can delever over the next couple of quarters, this is a business that's trading at $150 million in market cap. And if they can get back up to where they were, 200 million in operating cash flow, you can begin to see the opportunity. Very similar to Transocean, but there's a lot of work that needs to be done there. Tons of work that needs to be done there. So it's incredibly difficult to consider these type of plays. They're really, 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 really difficult to sit through. But if they play out, you can make a lot of money. What I'm beginning to realize, though, I was able to make a lot of money in these type of plays over the past decade with interest rates closer to zero because the play was always very simple. Zero interest rates, what you do is refinance, push your maturities further out, restructure, sell off non-core assets. As of right now, these guys are selling non-core assets at a time where prices are very low, not a good time to sell. They're restructuring debt, but interest rates are higher. So even pushing maturities out won't work. It used to work a lot better over the past decade. But 2022 is an eye-opener for me that maybe focusing on higher quality business, like look at the Taro Company. It's not the cheapest right now, but this has been performing incredibly well. It's back to fair value. We took a little bit off the table. Actually, I cut it in half. It was up about 34% inside 3-4 months. We'll get paid for the risk that we take, offset some of the rest of the portfolio while that starts to work. But these higher quality businesses might be better focus longer term. That's sort of my realization. But that was the idea behind Tupperware. Very ugly quarter, but yeah, these turnaround plays, if they're successful, they pay out huge. And Transocean is one where it hasn't, like, you can look at it right now, like this is up 54% in the last month. Over the past month, this is up 67%. It's very volatile, very difficult to sit through, but when they play out, you can make good money. But anyway, it's sitting through that volatility. So that's the first part of that question. The second part of the question was, where was that question? Was related to the rest of the cash. Regarding, okay, so am I planning to invest the rest of the cash on hand? Do you expect the market to go lower? What stocks am I potentially looking at adding? So yes, the cash that's in the bank is ready to go into Celanese. These guys are reporting after the bell. It is already a cheap business, but the thing is, it can look cheap today. High energy costs, high labor costs, low commodity prices, which is what we're seeing at the moment. Horrible combination. We're seeing that with Alcoa and Nucor. Well, more so Alcoa. Near term, it's kind of difficult. I'm looking at this in the mid 80s to start scaling into it. I'd like to build it out to 5%, but half the position on mid 80s and build it out maybe mid 70s. It's a company that pays out over 5%. The CEO is a total stud. Basically, what these guys sell is polymers. So it's plastic that goes into manufacturing inhalers. So unless you believe that business is going to zero, they just bought an M&M deal. I'm looking to see after hours and the earnings. They just closed that yesterday. So I'm looking to get a little bit more insight into that business. $10 billion in debt, $2.5 billion financed in Europe, 7.5 in the United States. So got to look into that a little bit more. I think it's fixed rate debt though. But it's trading at like 5 times earnings. It has room for earnings to compress a little bit at its current multiple, and that's what's priced in. If that doesn't play out, it would recover. But these would be longer term plays for me. The CEO is a stud. She's a real good quality operator, doesn't make any excuses. And they've changed and optimized their business over the past couple of years for cash flow. So let's say, oh, by the way, so the polymer is part of the business, and then I can't pronounce the name, but the other part of the business is this chemical that goes into like paints and stuff like that, sweeteners, and goes into medical products. Anyway, all the products essentially that their products go into, it's somewhat non-discretionary. They've got staying power. And these guys have a 30% market share, certainly in the polymer industry. So they've got dominant market position. So as we move forward, what these guys are doing is optimizing for cash flow. So let's say we have a situation where this is how one of their executives explained it. Let's say they have too much supply in Asia. Rather than increase production, let's say in Europe, they'll just ship it over. And they will optimize supply chains for demand, and they'll focus on free cash flow. So if it's cheaper to manufacture more supply, they'll do that. If it's cheaper to ship it, they'll do that, but they're optimizing moving forward for cash flow. So I really like to hear that. Company's very cheap. And I think we're going to go into another decade where these type of companies will have pricing power. They'll do very well. And I think it's a well-managed business. So as of right now, I'm looking in the mid-80s. That's why it's just sitting there. I just don't want to pay the current prices, being a little bit tight. Regarding macro, the U.S. midterms next week could change everything and leave a Biden lame duck admin for the next 2 years. Thoughts on impact on share price? Yeah, that's a good question, and it's really difficult to say because that could be good, but good and bad, because the Biden administration's energy policy is horrendous. Jennifer Granholm should not be in charge of energy policy. She doesn't know what she's doing. She hasn't got a clue what she's doing, and it's gut-wrenching to listen to her speak about energy. So the good news would be you get gridlock, and a lot of these stupid energy policies dissipate. Inflationary pressures related to energy starts to come down in the US. That would be great, but it's really hard to know. It looks like Republicans, Miami-Dade the polling started opening yesterday. Republicans were ahead already early over there. So it does look like Democrats would be in a little bit of trouble, but that's all speculation. I really couldn't comment on it. Hi, Rob, question on CleanSpark. Do you think that energy prices can go up that far so that mining will not be profitable? So when you look at CleanSpark, these guys used to own microgrids, a microgrid company. Their expertise was in energy optimization, essentially. So what they're doing right now is they're buying miners, GPUs, and these GPUs have fans, and they're removing the fans, and they're sinking the machines into water and oil. And it makes it 1,000 times more efficient to keep them cool. So you don't need tons of energy powering these fans in order to keep these units cool. So that's what they're doing. They're modifying these units. They're sinking them into oil and water, and it's keeping them colder without the need of tons of electricity. That's one of the competitive advantages that they have. And then they've got a number of pretty good energy contracts. So they're the only ones that are really optimizing in that way. The cost of energy, well, the all-in cost to mine a Bitcoin last month was $10,700. That was their essentially cost of production. So Bitcoin prices could still moderate and they'll do perfectly fine. The largest Bitcoin miner just defaulted on their debt. So if you look at Core Z, these guys just went to zero pretty much. They defaulted on their debt. These were the biggest miner in the space, but they were reckless. When Bitcoin sold all the way down, they had to sell 69% of their Bitcoin holdings to raise some cash in order to finance their debt. They have $1 billion on the balance sheet at 8% interest, and then they're trying to mine at a loss. It didn't make a lot of sense. And so the good news is the longer Bitcoin prices stay around 20 or below, what you're starting to see is a lot of these miners are becoming uncompetitive, starting to shut down mining, or they're having to liquidate. CleanSpark just bought miners at they just spent $5.9 million buying miners at an 87% discount versus 1 year ago. They didn't say who they bought it from, but Argo blockchain Argo Blockchain just sold 5.7 million because they couldn't finance their debt. So because you have low cost of reduction from CleanSpark, they're able to optimize their balance sheet, they're able to use their equity, and they're able to acquire miners at like 80-90% discounts. They're also still very profitable. If you look at the last month, they increased their Bitcoin holdings in their vault by 13% month over month. So that's after all their expenses. They're really doing a fantastic job. The longer Bitcoin stays lower, the better it will be long term for CleanSpark. They're currently at 5 exahashes. They're expecting to get to 5.8 by the end of the year, and they're expecting, which is or 5.5 by the end of the year, and then 22.4 by the end of 2023. They'll be one of the largest Bitcoin miners. Look, I think they're executing really well. They're very aggressive with their M&A strategy. I hope they don't go too far, but they're optimizing equity, not debt. And I guess it helps that Zach, the CFO or the CEO, is a CPA. So he's going to be conservative. He's a certified public accountant. So with CleanSpark, I mean, I'm really excited about this company. I mean, it could push lower in the near term, and I don't think that would necessarily be a bad thing because the rest of their competitors get crushed. They keep building out the number of miners that they have online, and eventually I think you'll start to see Bitcoin perform very well. I don't know if you guys follow a guy called Michael Howell, Cross Border Capital. He's a liquidity guy. He's a legacy finance guy. And he's been on the money about liquidity, central bank liquidity. And he follows just basic assets like indexes and stuff like that, but also Bitcoin. And on a number of occasions, he's shown the correlations between M2 money supply, growth of M2 and Bitcoin. And he seems to be getting more and more bullish as of right now based on his expectations for M2, which is fairly like I don't know when it'll happen, but fairly reflecting what my view would be as well. Based on what we said at the beginning, government debt is just not sustainable. So I think it's a matter of time before Bitcoin bottoms out. There was only, I think it was 2, maybe 3 Bitcoin miners that are actually profitable last month. That's it. All the other Bitcoin miners are already underwater, not necessarily because they can't produce Bitcoin at lower prices, but because some of them over-levered their balance sheet with debt. So we have a situation where I think it's Bitfarms, CleanSpark, and Riot Blockchain. There's only those 3 that were actually profitable last month. So we're at a very interesting time right now for digital asset miners. But yeah, it's just trading at 0.3 times tangible book value. That's the value of their assets, which are profitable. And I just think, a matter of time, Bitcoin prices start to increase. Those margins start to expand. They continue to build out more and more exahashes. So we're only paying 130 million, less than that, I think it is. 123 million is what the current price is. But I continue to convert the Bitcoin into CleanSpark because I think the expected returns here would be a lot better. So I think we'd have to get down probably below like 15,000 for a very sustained period of time for it to be a big problem for CleanSpark. But I don't see that as an issue as of right now. They still have about 18 million in liquidity. It's about 15 million in their vault. And I think they have something like 2 or 3 million in cash. Am I right in thinking your top-down base case sees the end of the dollar strength? If so, would a good move to diversify to places with lower natural inflation, somewhere with cheap energy, raw materials? So I do think we're in probably the 7th, 8th innings of the US dollar strength. Yes, I do think we're in the latter stages of that. I'm not sure I get what you mean. Diversify to places with lower natural inflation, somewhere with cheap energy and raw materials. Here's the thing. The United States is, if you look at the composition of inflation in Europe and you look at the composition of inflation in the US's inflation is not coming through energy. It's coming through shelter. It's coming through some commodities, agriculture. It's coming through labor. If you look at Europe, it's coming through energy. So the composition of both is very different. 6%, about 4.5% of the inflation rate in the US right now, the headline is shelter alone, owner's equivalent rent. So the US is energy independent. They've got plenty of oil and gas. If you just get Biden's administration out of the way, and maybe we get it in the next couple of weeks, the US is energy independent. They should be perfectly fine, but we will soon find out. I don't think energy in the US is not necessarily a problem. If we start to see the dollar come down, it doesn't really matter because what ends up happening is, like, look at Amazon. Yeah, I own the company in US dollars, but their earnings are going to go up in rest of world currency as well. So I'm not sure if I answered your question, but I just really like investing in the US. And I think you're starting to see that come to fruition now. There's a lot of markets that are under pressure. So a lot of stocks in the US making new all-time highs. Like even if you look at, Dick's Sporting Goods is a company that I follow. Look at the Buckle. These are all very cyclical businesses. The Buckle year to date is down 9%. Adjusted for the dividend, it's down 6.7%. Year over year, this is down it's up 2% adjusted for the dividend. And so there's a lot of businesses that are very cyclical. This has no debt. Fortunately, it's not on eToro. But the Buckle has no debt, a lot of free cash flow, high return on invested capital, high return on equity, high return on assets, performing very well. There's a lot of companies in the US performing very well that are domestically demand-led, like even CAT more recently screaming higher on earnings, a Taro company, what we own. Like even Crocs, it's only starting to perform well, but it's still up, what is it? I mean, it's up 66% off of the June lows. There's a lot of areas in the US recovering. I think the US is probably one of the best markets. That would be my personal view. Are we doing anything with Tupperware? I don't plan on doing anything. It's a smaller position. But again, as I mentioned before, there's, Q4 could be a Hail Mary. Let's see what it's like. How do I keep my cool while putting in all this work and seeing the portfolio go down like this for a long time? I'm losing sleep just copying you. It's not easy. I've been doing this for 13 years, and I still feel like crap every single time the market goes down. So it gets a little bit easier, but it still doesn't feel good. But the one thing I'll say is I go over the portfolio and the companies in the portfolio, on a weekly basis. So I really understand what I own. I understand from a macro level where we are. I know where the pain is coming from. Higher interest rates causing multiple compression. It's also causing a stronger dollar, which is hitting on an adjusted basis, multinational businesses' earnings. And so I understand where the pain is coming from. I know that there's limitations to that as well. And I'm pretty confident that, portfolio will bottom out and perform very well over a reasonable time horizon. So if you look at it like it's a business, here's the thing. Most people go out and buy a house. Let's say you paid $500,000 for the house. You have no idea what the real value of it is on a day-to-day basis because you don't have a ticker. But if somebody knocked on your door randomly and said, hey, I'll pay you like $400,000 for your house, you would slam the door in their face. You don't know what the house is worth because it's not listed on the market, but you paid $500,000 for it, and it's worth more than $500,000 to you. Well, these businesses are worth far more than what I paid for them to me based on the cash flows that they produce and the expected forward performances. And that's the way in which I look at it. And so I see a lot of people, like everyone's transitioned to using like stop losses, trend lines, technical analysis in this drawdown. There's nothing wrong with that. But having a fundamental conviction in a company and using stop losses is like oil and water. It's like driving a car off the showroom floor, depreciates 15%, swinging around at the next roundabout and dropping it back off at the dealership because it went down 15%. Doesn't make a lot of sense. We have to analyze the business, figure out what the cash flow coupon is, those expected returns are likely to be, and then it's an auction market. Every minute of every hour of every day of every week, the prices are set. And as of right now, nobody wants to own these assets, so it's the best time to buy it. And if you go back to January and February 2021, everybody wanted to own these assets and the multiples were massive. We'll get back to those periods at some point in the future. So that's sort of how I balance it is, knowing what we own, understanding the limitations to how far we can go in monetary policy, and being patient. That's it. Here's the thing, somebody recently asked me, it's like, I think the portfolio might be up 20% or I don't know what it is since inception anyway. Not fantastic. But somebody asked me like, I can't remember what it was, but was that good or am I happy with that? And, like Warren Buffett, if you look at Warren Buffett, I think everybody would agree he's a smart guy. He's been around for 60 years. And the beautiful thing about that is we can see the peaks and troughs that guy went through in order to hit 20% compounded per year for 60 years. Excuse me, my throat. Between 1970, 1971, 72, 73, 74, the total return for Berkshire Hathaway was 0%. He didn't make any money. And on that last year, he lost 48%. Yet his long-term track record It's 20% compounded. It's pretty damn impressive. It's really, really, really impressive. But it goes to show the struggle during specific periods. I don't know if that's going to happen right now. I don't think it's going to happen because of what my expectations are. But you make a lot of money over the long term. And going back to that idea of stop losses, if I set a stop loss, you bet your bottom dollar that my frame of mind is to take profit as quick as I can until it gets back to profitability. Most of the money that you make in the market is letting your runners run. And that's sort of, it's hard. It's hard. Not a lot of people make money in the market. And it's not that they can't. It's, I think it's just pretty damn hard to sit through volatility. And I can tell you from experience, it's not the first time. 2015 was as bad as this year for me anyway, physically and emotionally, and sort of dealing with all this. And it doesn't go away. It doesn't go away. You have a couple of bad years, and then you have 3-4 years, good years, and then you have a couple of bad years. And averages out. I didn't expect this year though, so I'm definitely caught flat-footed, and there's a lot of things that in hindsight I would do different. Nice to see you, Theodore. Itaro is saying I can no longer copy you. I think it's after I filled in a questionnaire on the investing goals. I'd love to keep investing while the valuations are cheap. Any suggestions? Yeah, look, I don't know what Itaro's plans are, but my mom's also invested in the portfolio, and they sent her an email to stop copying but keep the position. So I don't know if they're unwinding the Popular Investor Program. I don't know what they're doing. They haven't said anything to me. I didn't receive that email, but anyway, I love investing, so I'll keep doing it regardless. So I don't know if the copy block is there to prevent people from copying. I don't know if they're unwinding the program or what it is that they're doing. So it could be that, because a couple of people have said that, but thank you very much for the support. And I agree, if you can find good quality businesses, keep averaging in. Now is the time that you want to be building out your portfolio. It really is. And when it gets very hypey out there, consider the valuation, and maybe it's the time to start trimming some. Love to see it back. Love to see it. Thanks for your support, Dominic. One of my bigger bets during this bear market, am I planning to boost your positions? If yes, and which? So one thing that I've done, and I didn't do it in the eToro portfolio, but I've done on my personal portfolio, I've taken a very significant position in CleanSpark. I've been building it out, still have to build it out. I had a big position in Bitcoin, but I'm very confident, based on the debt situation with the US government, that the Federal Reserve are limited in what they can do. And CleanSpark have enough time to see this through. And Bitcoin's very correlated with M2 money supply. So if we get yield curve control, balance sheet starts to expand, M2 starts to grow. We're already seeing Bank of England do it. We're already seeing the European Central Bank do it. Well, the European Central Bank are doing not QE. They're buying $330 billion of corporate debt, but that's not QE apparently. Bank of Japan doing yield curve control. China are starting to ease. All of these different central banks are already easing. The Federal Reserve are the last ones, and they're the one that are most critical in my view. So I think it's just a matter of time. CleanSpark have that time. So that's a big bet that I made, where, look, I think CleanSpark could do 30 to 40x out the other side. I wouldn't encourage everyone to make the size bet that I have, but it's one of those where it looks crystal clear, and I don't think many of them are going to show up like that. So that's a big bet that I've made. And I was hoping, if you look at rig, I was actually hoping this would break down. I was hoping it got back to $2 a share. Fundamentals are getting better. I was kind of hoping it would break down, and I was going to increase my position significantly in Transocean. Doesn't look like it's going to happen, but if we get a decent pullback, I might increase my position significantly there. They're the two that I've really, I'm really taking big bets on. The rest of the portfolio, I build out bigger positions in companies like Pool Corporation, but these are just very solid businesses. Pool Corporation it's such a durable, in a time where there's so much uncertainty, Pool Corporation is so durable. It's so durable because a pool's built, it lasts for 24 years. The owner needs to buy chemicals. The world's driven by envy. So no owner, and you can see this back in the global financial crisis when their chemical business never slowed down. No owner of a swimming pool is not going to buy the chemicals to treat their swimming pool. So you have a very durable business. Inflation is up 10% this year for the company. They pass that on. Margins remain robust. profitability continues to grow. So as of right now, trading at 16, 17 times, I continue to add to this. These type of companies are very solid. I could build out a big position and leave it for a couple of years, and I think it would be perfectly fine. This is a company that I could invest in, fall asleep for a decade, and come back and I'd smash the market. That's the way I look at it. What do I think of oil and gas companies and gold, silver, and platinum? So oil and gas, there's a couple of things with oil and gas. I'm in Transocean, so services is a little bit different, but I think producers might be a little bit under pressure. And the reason being is I think we're going to start to see hedging roll. So if we have a look at crude oil, if you look at this over the last 3 months, crude oil is down about 8%. If you look at it over the last 6 months, it's down about 16%. A lot of producers have hedged out production on a forward-looking basis. Prices are a lot lower. Their cash flow is based on those hedges. If they have to re-hedge, depending on the producer, the cash flow will be readjusted lower. So at these prices, I'm not interested in oil and gas companies. If they were to get hit pretty hard, and some of them I'm following and I've been following for a while, some of them I'm following, like Ovintiv. I'd love to get involved with Ovintiv, but I think there's possibility of lower prices there. Companies like Matador would be very interesting, but again, at lower prices. Yeah, there's a couple of companies like that in the energy space that I'm following. I was following Equinox. I am following Equinox, but it's a levered play. They had earnings today, and the all-in sustained cost is at $1,700 with gold prices below there. It's a good quality miner, but like they're mining in California, which can be expensive. High diesel costs, 30% of production of mining. Labor costs, that's a quarter of their business out of California, for context. Low geopolitical risk, but high input costs, so the gold price needs to push higher. First Majestic's interesting. This is they've got 6 mines in Mexico. It's a silver miner, but I haven't looked into it in a while. Barrick Gold, Newmont, those ones are probably about, and Kirkland Lake, maybe Royal Gold would be a royalty play, but that's about as far as I'd go there. But I'm not in, like oil and gas, I think could drop lower, and if it does, I'll definitely consider taking a position. But gold and silver, I haven't made a decision there at all. After listening to Q3, it seems like Zuckerberg only wants to have investors who believe in his objectives regarding the future of the company. Yeah, I think part of it is he considers the company has exponential risks with what Apple done, and he seems hell-bent on removing Apple and Google from the equation. He often talks about infrastructure, rebuilding the infrastructure, and that's essentially where I think it's coming from. But look, is it hard to trust Zuckerberg? Yeah, I mean, it's hard to trust anyone. It's you go out and you work your butt off to make some money, and you put it into another company and trust somebody else. That's bloody hard. So it's not just Zuckerberg. It's it's hard to trust anybody. Tom Shaw, I believe the 3-month and 10-year study said that they need to be inverted for 90 days. I'm not sure though. Okay, I need to look into that. The other thing that we need to consider, and the reason why I wasn't really paying attention to the 10-year minus the 2-year, which is here. The reason why I wasn't really paying attention to this is because, let me get rid of that, is because inflation adjusted, this didn't invert. And if you actually go back to the 70s, this inverted with high inflation. It inverted like 2 years before a recession, so it wasn't really a signal. Anyway, look where we are. We're pretty deeply inverted on the 2-year, but here we're inverted. It's kind of similar to 1998. And what's interesting is what happened in 1998. LTCM, long-term capital management, blew up. Why did they blow up? Russia defaulted on their debt. You had an emerging market debt crisis. Well, we're in a similar situation today. That was a $2 billion mess up back then. Today, it's a hell of a lot bigger. But it's very interesting that we had a slight break, which is what we have right now, slight break, in 1998, before we pushed higher and we had a couple of years of good performance. So we'll see how it plays out. Wayfair burnt 500 million in cash. Brutal. Haven't seen GoPro, but as it's sinking, it wouldn't surprise me. 2%. That's not that bad, but I haven't seen it. Who else? I don't want to look at Warner Bros. What are we looking at? 2% after hours. I don't want to look at anything until I read it because I don't want to draw judgment. I don't want to draw judgment on the earnings based on the price action because after hours can be messy. PayPal already free falling. Yeah. So somebody asked about PayPal. We used to own PayPal. I bought it at 103, sold a third of it at 122. Average back in, got an average cost of 96, and I closed it at 91, so more or less break even. And there was a couple of questions as to why I closed it. It was still trading at 20 times earnings. So Elliott Management came in, and Elliott Management cut costs, 900 million this year. Well, I say Elliott Management, I'm going to call it them. And next year, 1.4, I think it was about 1.4 billion. And that normalized earnings. They were still at 20 times earnings. Which I felt was okay earlier this year, but everything got crushed this year. Like you look at Celanese trading at 5 times earnings, return on invested capital at 22%, return on equity in excess of 20% as well, clean balance sheet, even after the $10 billion added after the M&M deal, in a very robust industry. I mean, it's going to continue to grow. They'll do buybacks, optimizing for free cash flow. Do I want to pay 5 times earnings for that? Like that's a 20% net income yield on that business versus 5% with PayPal. I decided that I was going to raise the cash and I was going to reinvest it. About the weekend after, closed on a Friday, and then that weekend, it came out that management were going to start confiscating money. And that's when I realized that I wouldn't get back involved in this business, even if it was very attractive. And the reason being is when you're managing money, forget about all of this sort of stuff going on between big tech or whatever. I don't really care. I can choose sort of what game I want to play in, essentially. But it doesn't matter what the view is. When it comes to money, it's a trust game. And so their job is to get further into the checkout. And what they're saying to their customers, we're going to confiscate $2,500 for misinformation. Okay, whatever. But that means misinformation. Who decides what misinformation is? PayPal. That's shocking. It's shocking that they would blunder. It's a payments company. It should be agnostic. If you want to make money, you need to be agnostic. And then when I seen stuff like that, confiscating $2,500 for misinformation that's determined by the company, you start to break down that social relationship with your customer. You're not getting into the checkout long term. You're not getting into the checkout further, and that's I decided not to get back invested in the company, and I stopped following it. I don't know what's going on with the company, but I stopped following it since then. I was a little bit disappointed to hear them say stuff like that, but anyway, it is what it is. Celanese Q2. Let's see. I don't mind this getting crushed. CEO seems very focused. Yeah, she is. She is a stud. She is really, really, really focused. Last month, they were like, look, macro headwinds are a problem. We're not making excuses. We've never made excuses. I'll show you that right now when I was reading, and I was like, damn, this is who I want to manage my money. Somebody that doesn't give a damn about all these excuses, but just focus on the job at hand. So if we go down here, she starts talking about macro, Lori Ryderkirk. Macro dynamics have done little to help us. This is nothing new. We have not and will not use them as excuses. Over the last few years, our team have delivered exceptional, even record performance while dealing with the global pandemic, severe constraints on raw materials and global logistics, record levels of cost inflation, and now add to that list a repair rise in interest rates. I love to hear that. Like, that's the person that's the steward of your capital. Just laser focused on the business. We'll manage what we can control. We won't make excuses. And that's what I really like. When I read that, I was like, damn, like I want to go a little bit deeper. But that's exactly what you want to hear from management. Yeah. Got to look into a little. I'm going to look at it a little bit later. So part of the reason why they bought the M&M company was to get a new contract with Toyota. They've got a whole suite of products that can be sold to OEMs. Toyota is the largest producer of vehicles, and they see synergies of about $450 million. Very interesting acquisition. Gets further into the auto industry, but yeah, they've got a big market share. I think it's 30%. I don't think it's 50%, but I could be wrong. Yeah, so I think it's more so 30%. I don't say housing is a little bit different. Housing is a little bit different to the auto market, but they have a number of exposures. I think it's 30%. They have 30% exposure in polymers as well, but they also have 30% market share in polymers. And then they're also in like pharmaceutical and drugs and stuff like that. They're also in food additives, and they're also in like their chemicals. I can't pronounce that. Acetyl, whatever that is. They make a bunch of stuff with that stuff. Food coloring, food additives, drugs. There's a whole suite of products that goes into paint, to paint the vehicles and stuff like that. So yeah, it's a diversified product range for sure, and it's a cheap company. What's my opinion on the recent acquisition of Cameco and Brookfield? Your view on Cameco and the industry? So Cameco, I've owned Cameco for a long time. I've owned Cameco since 2016. I still own, I don't know if you guys been following me, but I had a bit of a spat with a guy called Kevin Bambury back in September. The guy's a lot of industry experience, but he was saying stuff that wasn't necessarily true about the nuclear fuel cycle and trying to get like Wall Street bets and all to create this squeeze. And that's not the type of fundamentals you want to see in this industry. And so at that moment, I cut the position in half, and I've been waiting to build it out a little bit further. I like Cameco. Again, I bought Cameco because I had low risk. They had $1 billion in cash when I bought it in 2016. They still had long-term contracts paying out $60 per pound, so it's profitable. And they also had a revolving credit facility, so they were fine from a liquidity perspective. That's why I bought them, not because I thought that they would be able to make the most amount of money, but that I would make the most amount of money in the company, but more so that I would, not that I, what am I trying to say, but more so that I'd be able to last a very long period of time. So I bought this in 2016. I cut the position in half, in and around where the price that we're at the moment. It hasn't dropped much at all, but I would build this position out again. The acquisition of Brookfield, I don't know what to make of it, to be honest. Brookfield, I'll tell you why. Brookfield way overspent and went bankrupt on building out a nuclear power plant. So, I mean, I don't know what the synergy is there. I don't think getting involved in nuclear production is necessarily a good idea, but we'll soon find out. They had a Q&A recently, which I have to get around to. I think it might have been, well, I don't think it was to the public. I think they've done it with JP Morgan, but I got to figure out how I can find that. And I'd like to see like what the unit economics and what the idea behind this Brookfield deal is. It's not necessarily a bet the company, but it's a pretty darn big bet into another company that's not very efficient with capital. So I don't know what to make of it right now. We'll see. My view on uranium is that my view has been the same since 2016. I'm not very good at timing it. So for context, you could be waiting a very long time to make some money. But my view on uranium and nuclear is we're going to go into a massive growth cycle. I think we did start after COVID, though. I think this is just the first part of it. And we're going into a multi-year bull market. That's what my expectation is. They're unwinding the program. I got the email and it seemed like it was an extra feature rather than the way out. Yeah, I'm not sure. I just read it and a couple of people had mentioned to me they're copy blocked. So I don't know. I'm not entirely sure. Sorry for asking too much question. No, fire away. As a rookie, I really like to hear your thoughts on Overstock Q3 earnings call. CEO talks about potential M&A, pushing share repurchase program. What's your view on that? Well, I mean, look at this. If we get back to cycle highs with Overstock in terms of free cash flow, which I think we can, like markets are cyclical, industries are cyclical. It's all driven by credit expansion. That's it. Credit expansion, credit contraction. Right now, we have interest rates increasing at such a fast pace. It's the fastest increase in interest rates in history. Back in 1994, it used to be the fastest increase. Today is now the fastest. And so we have interest rates going up at a rapid pace, demand on the other side for interest-sensitive assets coming down pretty aggressively. Just as fast as interest rates come up, I think they could come down just as fast as well. So that's essentially where we are at the moment. We're in the gutter for this industry. I think it'll normalize in the next cycle, and I think you're going to see cash flows somewhere in the region of 100 to 150 million. Now, as of right now, when you look at Overstock, if you look at the enterprise value of the company, it's about 600 million. 600 million. So if they get back to cycle highs, cash flow 100 to 150 million, you're paying between 4 and 6 times cash flows today for those earnings. You've got tons of cash on the balance sheet. Only if you sink all of that cash into buying back the stock today do you start seeing an awful lot of those positive returns. So yes, I like the idea of buybacks. I think the current share price is very, 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 very cheap. They're still profitable in the current market environment despite all of the headwinds. So they could, sink another 200 million into buybacks for sure, 300 million even into buybacks. They don't need $428 million in cash. And so, yeah, I think that's probably a good capital allocation strategy. What you may or may not know about Jonathan Johnson is he actually bought the absolute low. I think he paid like $3 a share for overstock on the last crash, and he rode it all the way up to $130 a share. So the guy's kind of savvy. If he can pull something out of the bag with our shareholder money and buy back the stock at bizarrely cheap valuations in the next couple of weeks to months to quarters, it's only going to pay off dividends medium to long term. Medifast, didn't look into Medifast earnings, but stock down 10%, planning to add to the position. I am planning to add to the position. Medifast, I started with 2%. I'm just going to leave it meander for a while, and we'll make a decision over the next couple of weeks. I'd like to build that out to 3-4%. So Medifast, Optiva, they've got 58,000 coaches, and they sell these sort of liquid diets. And I know a lot of people don't like liquid diets. They do work, but the problem is when you come off that liquid diet, people start eating like crazy, and it may not be healthy either for depending on which physician you ask, but it does seem to work, and it was actually created by a doctor or physician back in the 70s. That's how the company was started. But the way in which it works is you got, I think it's 56 or 58,000 coaches, and they upsell Optiva, and Optiva, it's just a distribution business. But the profitability of this company is just absolutely insane. It is quite volatile. You can see the rallies and declines of tens of thousands of percent and drawdowns of about 70%. But the profitability of this business is bizarrely cheap. I started with 2%. I'll average into that. I might scale back. Maybe it might take a couple of months yet, but we'll have a look at the current portfolio and we'll consider the opportunity thereafter. But it's a small position right now. We spoke about that in the last live stream, but I was expecting a fifth wave lower. We'll see how it performs. I know some of you guys are not interested in this, but if we get 5 waves up and 3-wave pullback, I might average in another 2%. But yeah, I do plan on adding more. Very, 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 very profitable business. The US, I think about 60% of 68% of people have diabetes. 2/3 are also obese. I think this product still has a huge opportunity long term. It's one of the best performing assets in the market since the 2008 lows. It's up, yeah, it's only up 25x, even though it's down. This is down 70%, and it's still up 25x. The reason why this has performed so well is because it's just so bloody profitable. Look at the return on equity. Look at the return on capital in excess of 20%, well above the weighted average cost of capital. It's a very lightweight business that spits out a lot of cash flows. I really like the business. Warner Bros. Reported kind of bad earnings. Again, sadly, huge miss on top and bottom line. Yeah, the nuance of the earnings is going to be important. I haven't had a chance to look at it, but I haven't had a chance to look at it. We'll have a look. Yeah, is it down? It's actually doing anything, but we'll have a look anyway. I've got a lot of reports to look at after this, so maybe we might pack it in after these last couple of questions. We've got Medifast, Warner Bros, GoPro as well was reporting. A couple of them down. This one's down, but it's not much, so I don't know what the earnings are. GoPro are anticipated to be at $100 million ARR, annual recurring revenue. Look at the current enterprise value. Current enterprise value on the business because that's got a lot of net cash. GoPro is currently at 679 million. They have 100 million in ARR with a 60 to 80% margin. That's pretty insane. That's not the camera business. Camera business has a 28% margin. Average selling price $388. They sell 2.9 to 3.1 million cameras. That in itself is producing about $400 million in operating cash flow. So look, the valuation here Some of these businesses are bizarre. Just need some time, I think. Thanks for answering questions about Zim. You're very welcome, Tanner. LG, what's my take on FANG? GAFAM. I'm not sure what that is. High percent weighting of top positions and passive investing versus stock picking, active investing, moving forward. Okay, so that's a fully loaded question. Holy smokes. So my view on FANG, I think a lot of people, again, recency bias, they go back to the dot-com era and say, big, massive crash coming. I think where we are today is the equivalent of what the NASDAQ was. The equivalent of what the NASDAQ was back in 2000 is ARK Invest today. And the reason being is price earnings ratio of the QQ or the NASDAQ QQQs was 300. Right. So if you look at where ARK is, it's an unprofitable index. So I think the equivalent of that today is ARK. I think the QQQ today is more equivalent to something like the S&P 500 based on relative valuations. And a lot of those top tech companies, they're very profitable. They're very, very, very profitable. And so it's a completely different market environment. As well as that, when we're looking at inflation, people assume that the market and the margins are going to be exactly the same, but the composition of the market today is very different. We didn't have a tech sector back in the 70s and 80s when we had inflation. We had a lot of industrial businesses, low margin, capital intensive businesses, very different market makeup. So multiples are going to be different. Profitability is going to be different. Growth rate is going to be different. It's really, really difficult to know what happens. I don't have the answer. So I don't have the answer there. Some of them I like. Obviously, I'm in Meta and Amazon, but it's part of a diversified portfolio. And I am trying to optimize for valuation. Passive investing versus stock picking. Personally, I prefer stock picking. You're going to take on a little bit more volatility, but I think if you know what you're doing, you'll be rewarded in the long term. The reason why I say that is, if you look at the multiple on the S&P 500 right now, it's excuse me, 18 times multiple, right? Seems very expensive. But if you look at the equal weight S&P 500, I think it's 12 or 14. Anyway, it's a lot lower. If you look at the weighting of the S&P 500, top 10 companies is about 28%. And if you look at the average multiple on those companies, it's way higher again. So I think if you're stock picking in the current market environment, you'll do very well. As I mentioned a moment ago, like small companies like the Buckle, these are companies that are performing incredibly well. This is up year over year, 2% adjusted for the dividend, 6% down year to date adjusted for the dividend. Way better than most indexes. It's performing incredibly well. Not the type of businesses that you'd normally see, but smaller cap, no debt, continues to leverage on consumer strengths. It's doing very well. Those type of businesses, are performing quite well. Dick's Sporting Goods, those type of companies. So look, I think stock picking could be good, but I don't think a lot of people will make a lot of money in stock picking because now more than ever, you can see the type of volatility, the swings. The S&P 500 has 504 companies to average out that risk in. It's just an index, just getting the average of as many companies as possible. In a portfolio of 20 to 25, the volatility is going to be higher, but the expected return should be higher as well over time. So that's what my view is, but that's my view. How do I view oil reserves declining in the US and not sufficient oil coming online? Prices will go up and finally inflation again. Yeah, so I think that first and foremost, it's a really dumb policy. Said at the beginning, Jennifer Granholm should not be the energy. She should not be in charge of energy in the US. She doesn't know what she's doing. I think she was a school teacher and a lawyer, but she certainly doesn't know anything about energy. Draining the SPR is there for a reason. It's to provide energy during times of crisis, whether it's a hurricane, a world war, whatever it is. It's not there to get political votes. Supply demand economics solved for markets. So if the price of energy is very high, what happens? Well, capital expenditure comes back online, supply comes back online, exactly like what we seen in 2011, 12, 13, and 14. And what happened in July 2014? We had a glut. What happened to the price of crude oil? It goes straight down a slippery slope from 100 down to 25. We overbuilt inventory supplies for oil. Natural supply demand economics. This capital intervention is not a capitalist society. This is more, it's very left-leaning, borderline autocratic. Price controls, that sort of stuff. It doesn't make any sense, and it just leads to bigger issues down the line. Why? Because you're not solving for supply. Inventories are going down. There's only 200 million barrels left. That's it. That's all that there's left. So if they drained it all the way to zero, great. What are we going to do then? We still have a problem with supply. prices flare up. So yeah, I think prices will go up again eventually. Could I explain why you exited Dropbox? It still looks like a good investment. It does, but everything else around it has just gotten crushed. Absolutely crushed. So I like Dropbox. It's held up incredibly well, and it's done way better than the market. But there's a lot of businesses around that are good quality, high-end businesses that have gotten absolutely pummeled this year. On a relative valuation, I could pay 20 times for Dropbox, or I could build out a bigger position in Pool Corporation at 17 times, where I have certainty in that business. Taro Company is another one. I think part of it went, I'm not sure where that money went to, but Lennox International, all these different businesses got absolutely crushed. Cheaper valuation, more protected revenue stream, strong profitabilities, good balance sheets. There's a lot of opportunity out there, and I felt like Dropbox was great when everything was very expensive. And now everything's starting to get very cheap, and Dropbox, it's sort of done its job, and there's just other opportunities. So on a relative basis, what do I get up and do every morning? Look over my portfolio and figure out what changes. Am I very happy? Is this the exact portfolio that I need to outperform? Or is there something out there that's a little bit better? And I go over the thesis 1, 2, 3 times, and I make a decision. And most of the time, I just don't do anything. But in that case, with PayPal and Dropbox, I closed both of those. They're both trading at about 20 times. And I felt like it was a good time to consider, reinvesting that money elsewhere. Medifast is trading at, I don't know where it's at right now, what their earnings look like today, but I'll have a look at it. But it was trading at 8 times earnings. It's a company that's growing top line about 10, 12% on average. Very profitable business, good quality capital allocators, lightweight business. So if margins were to get hit a little bit, they'll be fine. Be able to pass it on. So those other opportunities are existing out there at the moment. GoPro had good numbers, double beat, reached 2 million subs. Awesome. I love to hear it, but this market is like, let's see. It's down. What have this company got to do? Like quarter in, quarter out, they're just absolutely killing it. And the market just doesn't give a damn. Eventually it will. They'll either buy themselves out. Burry said a couple of weeks ago that some of these companies, it makes fundamental sense, or it makes mathematical sense for them to go up because they've got so much cash. GoPro's in that basket. They'll just buy themselves out. What do I think of investing on the basis of ratio charts? For example, S&P versus gold, etc., or uranium versus S&P. It's still going to be driven by like correlation and causation are two very different things. So if I don't understand why something's going to move up or down, that just like if I've got a fundamental view, I can express that by looking at a ratio of one asset over another, and I'd be able to see exactly how that's playing out in real time. But that's just the way I look at it. I need a fundamental anchor in order to buy something. So if it does go down, I'm okay because I know what I own, and I know it's not going anywhere, and I know where the risk points are, and hopefully I've weighted that position correctly. With ratio charts, I mean, you could do very well. I used to do long short, leverage long short. Initially done very well, lost a little bit of discipline back in 2015. That's where I got crushed. Lost a little bit of discipline, took a little bit too much leverage, got hit pretty hard. But that's what I used to do. Long short hedge strategy, hedging out intra-sector, where I'd go long, JP Morgan short Wells Fargo, and I'd make the spread, and I'd lever it up 5 times. So that if the whole sector went down, but I owned the best company, it went down a little bit less than the worst company, and I'd make the difference. That's what I used to do, but that's a hard game as well. Would I be open to reading through an earnings report in a video so we could see what you focus on and how you analyze the earnings report? Yeah, I could do that. I'm not going to do it tonight because I've got so many reports to get through and it's already 10:15. But I can organize something like that for sure. Maybe we'll see who's interested, and we'll choose a date that makes a lot of sense. Okay, guys, we're at about 2.25 hours. I think I'm going to leave it there if you guys don't mind, unless you have any questions. There's Justin there. You mentioned in other videos you sold Zillow because rates are going up. Now that rates might be coming down, would you consider buying Zillow? So here's the thing with Zillow. This is why I sold Zillow. So you have advertisement on a home, And then you go towards buying a home, title insurance, mortgage, and then you have commission. But anyway, this is the value chain of buying a home. And Zillow take a space here, take a cut here, they 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 take a cut here. The problem is, this is a company that makes money off of the value transaction of a home. Mortgage rates go from 2% up to 7% inside 12 months. Home sales go to zero. Zillow are not making the money that they're guiding. That's why I got out of Zillow. I like Rich Barton. I like the company. They're a top of the funnel play, but the macro environment just killed their business and their forward guidance. I don't think they can achieve what they set out to achieve in 2025 because their business model is leveraged on the number of house transactions. If mortgage rates never get up to 7%, Zillow are perfectly fine. But when I started to realize that there's no way it would be better for me to put that capital to work somewhere else. That's the conclusion that I came to. Swallow the loss, move on. As rates go down, would Zillow be interesting? It'll definitely do very well, but with this Federal Reserve, I'm sort of like less. I've got a very little conviction. This is a Federal Reserve that said 1 year ago, we're not thinking about raising rates. And yesterday they're saying we're not thinking about cutting rates. So, yeah, it's the same Federal Reserve. Kashkari said in, 2018, we should raise interest rates. And then in 2019, he said, we had no precedent to raise interest rates. It's a comedy. Transitory. We're not going to do 75 basis points. It's just turning into a joke. It really is. And the fact that so many people are fixated on the Federal Reserve and they're so fixated on trailing data, like when you break down CPI, core CPI, which is a lot more sticky, 43% of that's owner's equivalent rent. And that's about 12 to 18 months lagging. And that's really what they're focusing on right now with raising interest rates. And you can already see it in the Treasury market with the volatility that we mentioned at the very beginning. There's a lot of cracks showing up, so we'll see. Thanks for your time, Tom. JJ, if I was starting from scratch, would you have the same portfolio you have now? Yeah, I would. You make a lot of money over time. You don't make money in a very short period of time. When I started investing, I wanted to make money for 40 years into the future. If you think about it, like, can I pull up a calculator here? So if you think about it, if I was to invest, I don't know what number is that? That's 100,000. Eyes are gone square. Let's just use 100,000. If I was to invest 100,000, and make even just 10%, like the average of the market, 10% to the power of, which one is to the power of? This one here, to the power of 40 years, my 100,000 turns into $3.5 million. And so I would invest, not add any more money. Where you make a hell of a lot of money is every single month you add a little bit to your portfolio. But if I was to start investing at 20 years of age, and this example, let's say you just put 10,000 in, not 100,000. Let's say you put 10,000 in, you made 10% every year, compounded in an ISA, 401k, whatever, or clean, whatever, and you made that for 40 years. You made 450,000, 45 times your money. So I think people overestimate what they can make in the near term, underestimate what they can make in the long term. So would my portfolio be the same? Yes, because like I said, a hurdle rate, I want to make over 20% per position. And so if you look at something like Cameco, for 4 years, after 4 years, I'm down like 30%, 40% on my position. I added some more, but 4 years later, I was down like 30, 40%. I don't know. In 2000. Today, based on the compounded growth rate versus when I first bought it, I'm making 25% compounded per year over that time in that investment. And I've done nothing since then. So over time, you make a lot of money. It doesn't happen all at once. Transocean is another one where this was dead money for a bloody long time. And even over the past 2 years, it hasn't done anything. But if I hold this for a number of years, we'll see when we get out. But if I do make the type of returns I think we can make, average costs like $350, I think we can get up to $25, $30 per share. you're making 6, 7, 8 times your money. Even if you have to sit through 5 years of that, your compounded growth rate's massive. So you can see how quickly this starts to accumulate really quickly. So would I have the same portfolio? Yeah. Diversified, good quality positions. Yeah. If you get through the report from WDD tonight, would love to hear your thoughts. Absolutely. Thanks for the stream. You're very welcome. Since I'm a teacher, I would like to do some teaching my students and would like to work with your material. I think you're great. Really appreciate that, Clyde. I actually am starting a YouTube channel with just some education videos in my spare time. So let me show you what I have. I've got a bunch of stuff. So I think it's this one here. So Clyde, I didn't like the YouTube videos I used to do because I didn't think they were helpful. But what I do think is helpful is showing people how to really analyze. So it's the superhero stuff. But so I have stuff like reading balance sheets, cash flow statements, different profitability metrics. I've got more stuff I'll show you now. So I'm doing all this now in my spare time, just making these videos. And I'll post them maybe tomorrow. I'll start posting them. But if I think it'll be helpful, but we'll see. So I create these little whiteboards. So interest coverage ratio, weighted average cost of capital, and just explain in a practical manner how it works. So this is Crocs as an example. You would use the weighted average cost of capital, comes out at 12.54%. Like, what does that mean? Well, how much money did it make? Well, 21% return on invested capital minus 12.5% cost of capital. They're making for shareholders pretty good money, 9%. So we know that management are able to generate shareholder value for us. Now, if you look at the share price, on any given day, it might go up or go down, and people will say, well, that's a piece of shit, or that's a great company, just based on the share price. But beneath the surface, these sort of metrics tell you whether it's a good company or a bad company, and just explaining that, like how we would go from looking at cost of equity, we'd use capital asset pricing model, looking at after-tax cost of debt, because interest is tax deductible. So we need to understand what the tax shield is, and then obviously coming up with the weighted average cost of capital based on the capital structure. This might sound complicated. These are just small stuff that could help a lot of people understanding how this stuff works. So anyway, I'm sure you guys didn't come here for that, but Clyde, that's what that is what I am working on. So yeah, where is I think it's there. So I have some videos already up, but I've got a couple more still to go, and I'll post them soon. Thanks for covering so much ground today. Usually have to re-listen a couple of times to take it in. No problem, JJ. It'll be still up there. Thanks for your time. You're very welcome, Theodore. Okay, guys, I'm going to leave it there before my back breaks. I really appreciate your time today, and we'll do it again sometime next couple of weeks. It's always something to talk about, but yeah, not an easy time to invest in, but you know, there's light at the end of the tunnel. Okay, guys, have a wonderful day, and I will catch up with you guys soon. All the very best.